to spin off or monetize their ESPN offering. Where do you see the growth coming from?
They're doing, I think, a lot of different things for growth. So one was obviously that investment that they have in Epic Games, which is a little bit tangential, but I think that is, definitely an investment for future growth. And even with the ESPN streaming app, yes, one part of it is definitely a defensive move, but I think they can, ultimately, they're kind of looking at this to add to the bundle. I mean, this is the beginning of the great content rebundling, right? So you have the ESPN standalone, you have the super app. They're really looking to reclaim all of those people who kind of cut the cord. And we have 30 million cord cutters, which is obviously going to get even worse with this new streaming app. But I think they think that it can definitely be a new, kind of growth area for them. And then, of course, you have the parks business, which is, they're investing heavily in that to grow that as well. So I think there are a lot of growth drivers that they have. Of course, the linear networks is kind of going to be a constant overhang for them.
There is a question, though, about what kind of price you're talking about with the ESPN app and the spin-off with this consortium. Do we have a sense of what kind of revenues they're hoping to get, what kind of pricing there could be?
Yeah, so I think there has been some speculation about that super app, the one that's coming out this fall, along with Fox and Warner Brothers, being somewhere in the $40 to $50 range, which kind of makes sense. Again, it's going to be interesting to see whether people would really subscribe to that. I think it's still a fairly compelling proposition. I mean, you're not going to get everything. You still will need, Paramount Plus. You still will need Peacock for kind of that whole suite of NFL programming and some more sports. But just that super app itself does give you about 50–60% of all the sports content that you want to watch in the United States. So I think it's still a pretty compelling proposition. In terms of the pricing for the new ESPN standalone app, they really didn't give us much color on that. Obviously, it will have to be less than that super app. So I'm thinking maybe around a $25 price point. But again, that app is going to be a little different in terms of the functionality that it offers, because I think they're trying to integrate sports betting and a lot of more interactive features in that app. But yeah, you're absolutely right. A lot is going to come down to pricing and then subsequently demand.
Geeta, I'm just a little bit confused on ESPN. So in 2025, they're going to have the ESPN streaming service that's different than the ESPN Plus, what they currently have, on top of a bundle with Fox and Warner. Which one should they really be throwing all of their eggs into?
Yeah, I mean, I think this has been a little bit of a head scratcher, right? We don't know whether the ESPN standalone is going to cannibalize, the super app or how exactly it's going to work. But I think ultimately what Disney is really looking to do is make, aggregation at the end of the day is the holy grail, and Disney knows that. Disney knows that bundling is really, really important. I mean, if you just look at their streaming bundle, I mean, this is the most popular bundle out there in the marketplace. 40 to 50% of all their subscribers take the bundle, so they know it works, and they want to offer different things, so different flavors of that, right? You have the super app with content from different providers. You of course have then the ESPN Plus app, maybe for the hardcore fan who wants to get into betting, who wants to get into more kind of these interactive features. So I think at the end of the day, you have that base bundle, and then they're going to be able to offer all of these different flavors with kind of up-tiering and upselling possibilities.
Geeta, did they give us a price yesterday?
They did not give us a price, no.
Still waiting for a price and a name, I think. Geeta, thank you. Geeta Raghunathan there of Bloomberg Intelligence. Lisa, that's a question for the CFO a little bit later this morning. And they decided a price.
Yeah, well, and everybody's sort of gaming out $40 to $50. Let's find out from him the details. He's going to tell us all. I don't think he's going to.
Didn't get the 40 from nowhere, did we?
No.
Feels like 40 to 50. Does that sound about right?
I mean, it seems like everyone's kind of coalescing around that, so it gives them a free pass. Question is, how much do they expect to earn from this, given what the distribution is likely to be and how much revenue sharing there has to be?
Does this feel like a Hail Mary to you, like quickly thrown together? This is going to launch in fall. We don't have a price or a name yet.
You know what I find interesting?
Raptor. Well, it might be.
Well, but they didn't tell any of the sports teams.
Yeah,
and
the Wall Street Journal.
And I wonder what kind of animosity there is from some of them saying, "Whoa, hold on a second.
Yeah.
What exactly are you doing, and how could this potentially affect us?"
Sports rights, how expensive or not they're going to be in the future off the back of a deal like this. So Disney is positive in the pre-market, has been all morning. Your broader equity market is lower by 0.2% on the S&P. Coming up next in the next hour, here's the lineup for you. Dan Greenhouse of Solace Asset Management, Justin Slacksky of Schenkman Capital, Christina Campmany of Invesco, and Disney CFO Hugh Johnston. All of that and a whole lot more from New York City this morning. Good morning. The next hour of Bloomberg Surveillance. Up next.
ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3,000,000% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, aren't you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
We still think recession risk is potentially out there, but we think it's not the base case at this point.
I think we need a little more data to be really confident ourselves that, we're going to avoid this recession.
You don't know if you're going to go into recession until you actually go into recession.
We do see a soft patch coming in this economy during the middle part of the year.
There's some validity to saying that, hey, if things are going well, they're just going to continue to do so.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
This hour, cruise lines. Stay tuned. From New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market is negative by 0.16% on the S&P. Certainly not negative yesterday. Very, very close, Lisa, to 5K.
And it was driven by the Magnificent Seven, some others as well. There is a feeling that things are going to go well, even if the Fed doesn't cut rates sooner. There's enough momentum to kind of keep things going and for upside surprise to be the biggest risk to so many different investment.
Now and again, we play this game. If I had told you earlier this year, would you have guessed? So let's play that right now. If I had told you earlier this year that the data would still look pretty decent, payrolls would be a blowout, ISM services would be really strong, prices paid would start picking up, manufacturing would threaten to go back into expansion, and the Federal Reserve would push back against this idea they're going to cut anytime soon. Would you have the S&P at 5,000? Would you have high yield spreads where they are right now at about 320?
I would have crushed the call. I would have been absolutely right. No, of course, I'd be hiding in a bunker thinking that we were going to go into gloom and doom. This question of, what is driving the economy? Where are we in some of the cycle? Are we early cycle? Are we late cycle? Still a big question mark. That said, volatility is picking up at the same time that you're seeing a rally. This is something Julian Emmanuel pointed to, and he said that hasn't happened before very frequently, usually before a decline.
It does feel like the doom and gloom, though, is getting absolutely buried to start the year. As I often say, this is an observation about where we are, not a judgment on the future. Lisa can get into that in a moment. But let's take the 10-year auction yesterday. Huge, $42 billion of 10-year notes coming to market. Is it going to be a problem? No problem. Tons of demand.
And how many people have pushed back on the idea that the deficit's even a problem? They talk about the fact that essentially it has never been that issue, and people are looking to lock in yield. If you can get 4.something% yield for 10 years, a lot of people will take it. It matters when it does, and until then, people kind of move on.
And it's not going to matter this year because it's an election year. But the Fed chair, Jay Powell, in 60 Minutes said when he was asked, is it urgent? He said, yeah, I think we could pretty much say it's urgent. And those CBO projections yesterday show that our debt level is now exceeding, it's going back to a record, exceeding World War II era levels. This is a huge issue.
So let's talk to Secretary Yellen. So she went in front of the House Financial Services Committee earlier this week. She's going to go in front of the Senate Banking Committee today. Are we going to talk about these issues, or are we just going to be talking about what's happening in credit, what's happening with the banks, the smaller lenders in this country?
I think given what we saw yesterday with some of these commercial real estate with the New York Community Bank, she is going to be asked once again about, is this idiosyncratic or is this going to have systemic risk? Potentially some Republicans, though, are going to want to point to the fiscal debt. The issue is whether or not it's Biden or Trump, you're going to get an increase in the U.S. Debt. We're not on a sustainable path. Even when it comes to the Trump-era tax cuts, Biden wants to keep some of those in place for those making $400,000 or lower.
I feel like right now when you have hearings in Washington, everyone in the market's hearing blah, 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 unless there's some kind of policy prescription. And really, in general, the macro story has been a lot of blah, 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 because all of the gloom and doomers have been wrong. And so people are looking at specific stories and specific churns and trying to understand those and tuning out the blah, blah, blah.
This is not personal for you at all. You're so done with Washington. It's amazing to me because, Lisa, it is February 8th. And you've got 9 more months of this.
I know, I've got to change my tune. I'm going to come around. I want to know policy, and they're not talking about policy.
It's going to get worse.
I know, but I want to talk policy, and the problem is there's just a complete dearth of it in any kind of serious way.
You have to get through the politics to then get to the policy.
Fast forward.
Fast forward. Let's fast forward now. Equities right now on the S&P 500, negative by 0.1% on the S&P, very close, I think within 5 points of 5,000 at the close yesterday on the S&P 500. Equity futures now down by 0.16%. Yields are going somewhere up about a basis point. No big moves here. 413. We talked a little bit about the 10-year auction yesterday. 30-year bond auction today, $25 billion worth a little bit later on this afternoon. In the FX market, the euro just a touch weaker, negative here by 0.1%, 107.63 on the euro against the dollar. Coming up this hour, Dan Greenhouse of Solace Alternative Asset Management as stocks hit new record highs. Justin Slatke of Schenkman Capital on distress in commercial real estate. And later on, about 7:30 Eastern Time, don't miss this, the Disney CFO, Hugh Johnston, on the company's blockbuster earnings and future partnerships too. We begin with our top story, the S&P 500 closing in on 5K. Julian Emmanuel of Evercore ISI with a warning. The move to the round number, or 5,000, increases the likelihood of sustained volatility in both directions. It's a mix of FOMO and fear. Dan Greenhouse, Chief Strategist at Solace Alternative Asset Management, joins us now for more. Dan, good morning to you.
Good morning to you, sir.
Is it a collision of FOMO and fear in this market right now?
It's been we were talking about this off air, it's been a collision of FOMO and fear for 15 or 20 years now. And I think when this idea that the fear component of it now, and it's always something, the fear component of it now is that all this is being driven by just 7 stocks. And admittedly, when 30% of market cap, 25 to 30% of market cap is 7 stocks, we should say 6. Tesla's quickly finding its way outside of that, but 20, 25% of index net income is driven by 7 stocks. It's impossible for them to perform as well as they have and not be the bulk of the performance. But if you look outside of those 7 names, I can give you dozens of stocks doing incredibly well. If it's just 7 stocks, pull up a chart of United Rentals, pull up a chart of the hotel companies.
The cruise lines.
The cruise lines. Pull up a chart of if healthcare is all Eli Lilly, really hilarious you are. Just Pull up a chart of Merck if healthcare is all Eli Lilly. There's any number of these stocks. And on the industrial side of things, look at a chart of like Eaton. It's not just 7 stocks. There's other themes that you can play as an investor beyond those names that are helping drive gains. Again, not exclusive to those to technology.
Perhaps credit is more instructive in that regard because we're not just talking about 7 names in credit.
That's right.
The whole credit market seems to be doing pretty well. Had a ton of supply to start the year. Demand looks pretty tidy too. Is that what you're seeing?
Yeah, I mean, listen, you would look at enthusiasm in the equity market in the form of PE ratios. In the credit market, you look at it in the form of spreads. And in IG, you have spreads sub 100 basis points right now. As you mentioned in the intro, in high yield, you're talking 325 or so, depending on your index. Those are pretty tight levels that suggest that on balance, the credit markets aren't particularly concerned right now. But again, that's not telling you anything that the equity market isn't telling you in the form of either trading at 20 times forward earnings or just the enthusiasm around the market in general.
I wish that we could zoom in on your tie so we could really understand what's on there. It's a helicopter with money coming out of it.
This is Bloomberg, and we can zoom in.
All right, well, let's zoom in.
We have advanced technology.
Well, thank you. I appreciate it. There is a helicopter, Bernanke, with helicopter money coming out.
The problem with doing this is the fact that it's Bernanke and not Yellen or Jay Powell is dating my tie.
Okay, but all right, so let's move past the dating. How much is this part of the story? That essentially the helicopter cash is still sloshing around and making people want to go on cruise lines.
I have generally been suspicious of the idea that this is all because of free money. You don't have the breadth of performance over the last 15 years, the improvement in earnings purely because of the Federal Reserve. And it's been a theme that I've rejected for 15, 20 years, and I continue to do so today. That's not to say that central bank and easy money or low interest rates can't be beneficial. It, of course, can. But the idea that everything everywhere is solely the result of stimulus checks or money being thrown out of helicopters is an idea I wholly reject.
There is a sort of curiosity, though, in the market, especially for someone who focuses on credit. We thought that there would be some real zombies that would be rooted out and killed off by higher rates.
Sure.
We have higher rates. They're not being rooted out and killed off.
Well, some are.
Okay, but I mean, we're not seeing a lot of distress.
Party City.
Okay, Party City. But I'm just talking about we're not seeing some massive defaults.
No, that's right. You have to go deep into the well if I'm pulling out Party City and Serta Simmons. That's right. There's not widespread distress. Now, listen, there are reasons for that beyond quote-unquote easy money, although the excessively low interest rates that prevailed in the post-COVID environment allowed a lot of riskier companies to term out their debt. The so-called maturity wall doesn't really hit until next year, and this has been something that we've known for a couple of years, but companies have to start addressing that maturity wall, call it 12 to 18 months before the maturities actually come due. So sometime starting now, let's say, a lot of these companies are going to have to start refinancing, and you've seen this already, you mentioned this in the intro in terms of I think John did, in terms of the amount of issuance that's coming to market. You're going to have to start addressing this issue, but that aside, there is no indication that you cannot address these issues. You may have to pay more, and certainly the spread between the effective yield on your debt and coupon is pretty wide, which means interest expense is probably going to go up, which is going to pressure interest coverage ratios for sure. But I don't think, as long as the economy expands, this is a problem for certainly not the IG market and probably not the high yield market either.
Can we talk about one part of credit that everyone's focused on at the moment, which is commercial real estate? We seem to have worked through, or still working through, a rate shock of the last 18 months. I think we're all still worried about whether we get a credit one this year and whether that's going to be in commercial real estate. You talked about some of the things coming due. We know some things are coming due in that particular part of the market.
Yeah, listen, we don't spend too much time on this. What I'll say is that Barry Sternlicht made some headlines the other day talking down in Florida saying this is a $3 trillion market that probably has $1 trillion of losses or something. Far be it from me to take issue with anything Barry Sternlicht says, but I will say of the $3 trillion, a good chunk of it is multifamily, a chunk of it is farmland. By the time you're done slicing this up, you're probably down to $2 trillion, and that's still a lot, and there are still losses to be taken. But there's also delineations between suburban office and central business and what we'll call Class ABC. Midtown Manhattan office space that has a gym and a laundromat in it is going to do much better than something out of the central business district. And you can expand that out to other regions throughout the country as well. Listen, look at the charts of SL Green and and Boston Properties, I think sentiment had gotten incredibly poor in the space. I don't have any particular insight into when these losses are going to be taken, although they probably will be taken. But I think the performance of the equities, at least now, tells you that people are starting to get a little, their heads are wrapped around the extent of the losses.
This is what we're trying to figure out, Lisa, whether it's single names, couple of lenders, whether it's a whole sector, whether it ultimately becomes a broader market issue. And the consensus at the moment seems to be the first and not the last.
I'm sorry to interrupt.
Sure, please.
Getting back to the fear and the FOMO, the concern about everything is that it becomes a broader issue, whether it's the debt and the deficit, or the dysfunction in Washington, or the Fed's balance sheet, or commercial real estate, or Ozempic and its effect on this, that, and the next thing. The concern is always that it becomes a broader issue, and the truth is, most times it does not become a broader issue. And this is not rocket science. Most of the time, public risk markets go up, and they go up because the meteor doesn't always hit the earth.
Should I be concerned that you're a credit guy who focuses on distress, and that you're just incredibly bullish and just dismissing all the doom and gloom?
It's not that I'm incredibly bullish. There are losses to be taken, but I'm also, I think, and everyone should be this way, I am a realist. I don't think I'm a bullish or a bull or a bear. At any given moment in time, the facts are X, and X means Y for your risk environment and your portfolio allocation. And I don't think anybody should be slavishly bullish or bearish. And just to toot my own horn here for a second, I was bearish for most of 22 into early 23, but then the facts started to change. The recession that I and a lot of other people thought was going to happen increasingly looked like it wouldn't. We discussed this on air a couple of times. You don't remember. And
I remember.
You have many esteemed guests, and I'm one of many, but
don't give me enough credit.
The facts started changing in early 23, and a lot of people remained bearish despite the change in those facts. But again, I think there are a few of us that said, well, wait a second, this doesn't seem to be happening. What does that mean for my positioning? So it's not that I'm a distressed guy who's particularly bullish. It's that the data is telling me to be risk on, for lack of a better word. If that changes, and it might, then obviously your positioning and your view has to change as well.
This is why I think the Fed is increasingly more relevant now, because ultimately the Fed matters for the following reason. Do they have the ability to respond to negative shocks? I think the chairman told us last week that he has the ability to react to negative shocks. And unlike 12 months ago, where if anyone talked about the market rallying, he'd give you his hawkish hits in the news conference, that's not where they're at anymore. They'll embrace the strength, and they can respond. In their words, they can react to weaker data if they need to.
And they have a lot more ammunition after hiking rates as much as they have. And I think that people are looking at that and saying, what a change 5 years makes.
It's a huge shift. It's a massive shift. Dan, it's good to see you.
Always my pleasure.
Congratulations for phenomenal calls in 2022 and 2023. We've been following closely.
Very quick, I'm reminded of when Ben Bernanke went on Colbert's show to put out his book. Colbert said, how courageous of you to call the book The Courage to Act.
And it's good to see you.
Thank you.
We'll leave that there.
Of Solace Alternative Asset Management. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Israel and the U.S. are split on a proposed response by Hamas to pause fighting and release dozens of hostages. Israeli Prime Minister Benjamin Netanyahu has seemingly rejected the proposal. Meanwhile, U.S. Secretary of State Antony Blinken told reporters that Hamas's response, quote, creates space for agreement. The U.S. has sought to ease the fighting in the Middle East since Hamas's attack on October 7th. Demand for rental properties in Manhattan surged by 14% in January, keeping rents higher during the traditionally quiet winter period. Don't I know it? The median price for new leases was up $4,150, up 1.33% from January of last year. That's still lower, though, than July's record-setting median price of $4,440 a month. New Yorkers have been seizing on the slight decline in costs from the summer peak. Cristiano Ronaldo is the highest paid athlete in the world. He's taking home $275 million in 2023 thanks to off-field endorsements and a lucrative contract in Saudi Arabia. A new list from Sportico found golfer Jon Rahm, basketballer LeBron James, and footballers Lionel Messi and Kylian Mbappe rounding out the top 5. Tiger Woods still came in at 14th with $80 million in earnings, despite playing just 3 events and taking home less than $200,000 in prize money last year. That's your Bloomberg Brief. John.
Danny, thank you. I just love that Tiger doesn't even need to try. Up next on the program is commercial real estate posing a problem.
Commercial real estate isn't worth what it used to be. The good news is it's a problem, but it's not a surprise. So everybody saw this coming. So it's baked into the rates.
A conversation coming up next, live from New York. This is Bloomberg. City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
My name is Nikolai Coster-Waldau, and I believe this moment in time will be when we started to transform the way we live to inform the future we want.
Let's go to a cooler place.
This show is about solutions and the people behind them.
Or they can actually dissolve plastic.
This would be a carbon-neutral jet fuel.
This is an optimist's guide to the planet.
Jamie
Connection Live.
the room bay.
2 hours, 12 minutes away from the opening bell in New York City this morning. Good morning to you. Equities are doing all right. We're negative 0.1% on the S&P 500. Yields are higher by a single basis point. Your 10-year 4.13. Had a ton of issuance at a 10-year yesterday. Really strong demand. 30-year supply coming up a little bit later on this afternoon. That's the scene for you. Cross-asset under surveillance this morning is commercial real estate posing a problem.
Commercial real estate isn't worth what it used to be, because people aren't going into the office. The good news is it's a problem, but it's not a surprise. So everybody saw this coming. So it's baked into the rates. And you're seeing it play out in the numbers right now. We're discussing that. But this isn't going to come as some pandemic-like surprise where all of a sudden it knocks the world economy over because we didn't see it coming.
So here's the latest. Regional banks' exposure to commercial real estate once again weighing on investors. New York Community Bank shares have been plunging over the last week after the bank said it was stockpiling cash for troubled loans tied to CRE, prompting some fears about a repeat of last year's banking issues in the United States. Justin Slacky, the CIO of Schenkman Capital, joins us now to discuss this and a whole lot more. Justin, good morning to you.
Good morning, Jonathan. Thanks for having me.
Usually we say CRE around this table, and a lot of people say there's not much to see here. What do you say back to the issues that are emerging over the last couple of weeks?
I think in the regional bank space, that's going to be a tough place to invest for an extended period of time. Commercial real estate is going to take years to play out. With what we just saw with NYCB, they have a particular issue where they have exposure to Manhattan, and 20% of their portfolio is in rent-stabilized houses. As those mortgages roll off, and they have to pay higher for mortgages, and they can't change the revenue side, that's going to squeeze margins. That takes time to play out, and if they didn't grow over $100 billion, we probably wouldn't even know about that problem. It's the fact that the $100 billion number was hit, regulation stepped in, and all of a sudden they had to take higher reserves. So these problems are throughout the regional banks. It just will take time to play out because there's no catalyst to really drive most of them to lower their valuations.
This raises a question when you take a step back, and it's something we were just talking about with Dan Greenhouse. How do you sort of figure out what's priced in and what's not? Right? We were hearing from Jim McKelvey yesterday. Everyone knows this. We've been worried about this forever. So how do you know whether people are accurately pricing the risk or whether there is something more significant that will justify the gloomers and the doomers?
Unfortunately, you don't know contagion until it happens. When Bear Stearns happened, you would have thought that would have been contagion, and it wasn't. And because it wasn't, you would have thought Lehman Brothers wouldn't have been contagion, and it was. And so, unfortunately, you don't know it until you see it. The reality is, we know commercial real estate is a real problem unless there's a catalyst that drives valuation changes. You're not going to see it go broader into the marketplace. So we do have some maturities coming up that will create forced marks. As that happens, you'll see a few banks probably struggle in here, but it probably still stays under the radar for the overall marketplace.
How much is private credit kind of masking a lot of problems right now, both in commercial real estate but beyond, with respect to the credit space?
Yeah, private credit has had an interesting impact on the public markets because as they've raised a lot of capital, they've been willing to finance companies that have been unable to get financing in the public markets. So companies that might have gone bankrupt previously, and so you would have already seen bankruptcy rates start to increase, have not, because private credit has stepped in and been willing to take on that risk. That's had two impacts. One, bankruptcy rates are lower. Two, the risk has moved into private hands as opposed to public hands. So we don't see those price movements as much as we might have in previous marketplaces.
Justin, there's always something to worry about. That was a theme of the program so far this morning. Last year, it was navigating the rate shock that was going through small and medium-sized lenders, regional banks in the United States. And I think there's still an obsession over credit risk. There just is a belief that it's got to happen. There's got to be a credit problem somewhere. We surely can't escape going from 0 to 5.5 on Fed funds without one. Are we seeing them beneath the surface? You talk about these rolling issues in credit, that it's not all at once, it's just from sector to sector at different times. Is that how you're framing things?
Yeah, and I think we are starting to see that underneath the overall market. We're seeing it in individual industries, and we're seeing it in areas of investment. So in industries, if you look at the cable industry, that's down 5% year to date in the high yield market. If you look at telecom services, that's down 3%. That's in a market where equities are doing really well and high yield is positive. You're also seeing it in more broader investments. So VC investing and private equity are two of the areas that benefited the most from the low rate environment. VC is having trouble with their valuations. PE is not able to monetize their credits and their names, and that's why they're holding on to investments longer. They're the ones where you're seeing it first. As we move forward, what's going to happen in a higher rate environment is we're going to move from what's been a beta market for the last decade, all macro-oriented, to a much more idiosyncratic, fundamental market. And we think we're in that transition now, and telco and cable is just an example of that.
Let's get into that then. What do you like right now? What are you doing? What do you like?
So it's amazing you've had two credit people on in a row because nobody wanted to talk to credit people for the last decade. So I'm excited that we have yield in the credit markets, and it's worth talking about the asset class. Okay? So I'm really excited about that because people want to talk to us. And I think if you look at the overall high yield market, between 7.5%, 8%, that hits a lot of bogeys for investors as a place to go to get interest income. Now, remember, you're not talking about necessarily total capital appreciation, but the overall asset class can now provide some real return to clients. That being said, you have to be really careful about where you take that risk because, as we're starting to see, you are seeing dispersion among industries, and we think you can see a lot of dispersion among the credit markets.
Are you hearing from people you haven't heard from in something like 15 years, 20 years?
Globally, yes.
Isn't that amazing? We've left behind the era of negative interest rates, and all of a sudden, income's back in the right places.
I just keep thinking about that beer goggle comment from the head of the Dallas Fed back in 2013.
I remember that speech, Fisher.
And I love it because it basically highlighted this feeling of, why is my high yield bond offering 4.9%? That's absolutely outrageous. And now we can say it's not. It's 10%.
We were talking about income in equities, do you remember? And capital returns in bonds.
Yeah.
That was like the last 10 years justifying that mess.
And now it's the opposite, although it's interesting to me that so many stocks, so many companies are now having to do dividends and buybacks and all that. They're trying to compete with the credit guys.
Justin, we've got a lot to talk about. I'm pleased to say you're going to stick with us. Thanks for being with us. Justin Slackley there, sticking with us for the rest of this hour. Coming up very shortly, Disney CFO Hugh Johnston on the company's blockbuster earnings and its plan to rebundle sports. All of that and a whole lot more in the next 30 minutes or so. Your equity market on the S&P 500 recovering off session lows. We're down by 0.13% on the S&P, and bond yields just a little bit higher, up by a single basis point. The 10-year 4.13 from New York City. This is Bloomberg.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Live from New York City, equities pulling back on the S&P by 0.1%. Just a small, mild move lower. On the Nasdaq, down by 0.15. In the bond market, 2-year, 10-year, 30-year, shaping up as follows. Yields just a little bit higher by a single basis point on a 10-year yesterday. $42 billion of 10-year notes came to market. Pretty decent demand today. $25 billion of 30-year bonds. Yields higher on the 30-year. At the long end of the curve, up by 2 basis points. 434.88. Turn to foreign exchange. Push those high yields through this FX market. Dollar just a touch stronger. Euro a little bit weaker. 107.57. We're negative on that currency pair by 0.14%. Under surveillance this morning, your top stories. Senate Majority Leader Chuck Schumer expecting widespread support for today's vote on an aid package for Ukraine, Israel, and Taiwan, now that it's divorced from U.S. border funding. A bill featuring both aid and new border restrictions was abandoned by Republicans last night. Even if the new deal makes it through the Senate, it's still unlikely to pass in the House. Now, Anne-Marie, this is where we were about 2 weeks ago, or something like that. We were talking about how we needed to put border aid in this package with aid for Ukraine and Israel. And now we're talking about stripping it back out and going back to the beginning again.
Plan B is Plan A again. And I will say Senator Schumer left the floor yesterday saying, I'm going to recess to, quote, give our Republican colleagues the night to figure themselves out. It was Republicans for months. If you go back, they had this deal on the floor and it was voted down because Republicans say not a dime to foreign aid until we fix our southern border. Now the southern border has become a hot political topic ahead of November. And now it's, okay, I guess we have to do the foreign aid, but without fixing the southern border.
Given how the last hour went, I'm not even going to ask you about any of this. Let's turn to China. Pressure mounting on China's government to provide further economic stimulus, with the country's consumer prices falling at the fastest pace since 2009. CPI dropping 0.8% in January, exceeding economist estimates. PPI falling 2.5%, marking 16 straight months of deflation for the price of goods when they leave the factory. Very different conversation in China over the last year compared to, say, the US and Europe.
Yeah, a couple questions. What can they actually do? Cut rates to zero? Okay, cut rates a little bit. I don't know. These are some of the things that people are speculating about. 2, a new person in charge of the Plunge Protection Patrol. And this sort of is interesting because it's sort of, what's a change in personnel going to do at the time when they really need to come up with a policy that can kind of support things in a more fundamental way?
I thought we called them the national team, not the Plunge Protection Control Team. Well, I mean, the national team in China.
Well, I mean, the national team could be a lot of things, national football, national, lots of things.
Stocks protection and all of that stuff as well. So that's the latest in China. Here's the latest with Disney. Shares rising after an upbeat profit outlook from the company, citing cost-cutting benefits and performance of its international theme parks. In a string of announcements, Disney saying it will invest $1.5 billion in collaboration with the maker of video game Fortnite. It is also partnering with Fox and Warner Brothers Discovery to create a new sports streaming platform. There's a lot to discuss with Hugh Johnston, the Disney CFO, who joins us now. Hugh, it's great to catch up with you, sir. We spoke for years in your years at Pepsi. Fantastic to see you in a new seat. Let's just get straight into these numbers if we can. Cost cutting. Can you walk us through where that cost cutting exercise is really biting?
Yeah, it actually is. And good morning to you, John, and to the team there. I'm very excited about the progress that we've made on cost cutting. To be honest, when you do these programs, you're always looking for, is it actually flowing to the bottom line? And what we communicated yesterday was $500 million of saves flowed through to the bottom line, and you can see it in the P&L in the form of margin improvement to the tune of 350 basis points. That's a huge, huge margin jump, and something that we've got a lot of confidence in will continue, because we're really getting good traction and good momentum on managing our costs more tightly while reinvesting back in the business to drive the top line as well.
So, Hugh, you've got a really strong story to tell this morning. The stock is higher as well. I certainly don't want this conversation to drown into a conversation about activists, but I need to ask about Nelson Peltz. Have you spoken to him personally at all since you took on the new role?
Yeah, I spoke to him a couple of times briefly, not recently. And honestly, we're just in a very different spot on this. We feel right now like we've got terrific momentum. Bob and the team have spent the last year both fixing the business and now pivoting to building the business. And you can see it in the results, and you can see it in our confidence as well. The share repurchase that we've communicated, the earnings guidance we've communicated, the increase in the dividend, all suggest that we have confidence that we're not only going to be able to do this for the short term, but we're going to be able to do it for multiple years. So honestly, I don't think we need any incremental help. I think we need to keep this management team focused on doing the things it's doing so that we can continue to deliver great results and make progress on the big strategic issues that'll help us emerge from the disruption that's going on in media in a much, much stronger position than we were in before.
Hugh, some analysts, including our own in Bloomberg Intelligence, wondering whether you're being too conservative on the outlook for streaming to turn a profit by the fall. Hugh, what would you say back to them this morning?
I'd say the guidance is to do Q4. If we do better, we do better, but the guide is Q4.
Hugh, can you give us a name and maybe a price for this bundle, the sports bundle? Everyone's just asking that. $40, $50, call it Spike?
Yeah, no, we haven't come up with a name for it yet. You know, the focus when you do a three-way JV is on how do we make sure that we get the operating principles right so that the parties are aligned up front and they're aligned ongoing in delivering a great product to consumers. And that's the real focus here is how do we make it easier and reduce friction for the sports fans? So we're going to get to pricing shortly. We'll get to a name at some point, I'm sure. But what's most important is I think we're going to deliver a product that's going to make your life a whole lot better if you're a sports consumer.
Hugh, do you think that ultimately the idea of a bundle going back to the future and getting people with reduced friction to find their sports team and find the game that they want to watch is going to take eyeballs away from some of the other providers, the cable networks, that have traditionally had these contracts? You're going to bid directly on some of these sports rights.
Well, I think it's going to be targeted more at people who either were never in the cable bundle or people who had already departed from the cable bundle. You know, at the margins, might there be a little bit of shifting? Yeah, there could be. But to tell you the truth, I don't think sports is going to be the reason that someone makes that shift all by itself. I think there are a lot of factors that weigh into that. From our perspective, we're focused on meeting the fan wherever they choose to be. I don't think we're motivating the fan to move. But if the fan does move, we want to be there because we want ESPN to be everywhere.
Hugh, we're super interested in how you're going to bid for those sporting rights. Do you think you might bid for them as a joint venture? How's this going to work in the months and years to come?
No, quite the opposite. We all will be bidding independently, and that's something that we're quite firm on, as that is not the purpose of the venture. The purpose of the venture is purely distribution. It's not about procurement of content. So we'll continue to compete with each other for sports rights, just as we always have. It'll actually, I think, be a great benefit to the league because it's no different in terms of the way we bid for sports rights. But that reduced friction benefits all of the leagues as well. So I think the leagues will actually be pretty optimistic about this.
There was some reporting yesterday that suggested the leagues weren't aware of this joint venture. Hugh, have you spoken to them?
I have not personally, but we certainly have as the Walt Disney Company. Candidly, when you're putting together a three-way JV and a three-way JV in the media business, trying to keep it private until you get the deal done is challenging enough. To involve more parties, frankly, just would have created, I think, too much risk. So we certainly let them know the moment that we announced it.
Hugh, we have lots more questions about the sports and the streaming, and hopefully we can ask you about them. But I do want to shift gears just a bit to Shanghai Zootopia. The idea that the Chinese offerings of Disney did pretty well, actually were stalwarts, which was surprising because we've heard a lot of a different tone from other U.S. companies. How much are you seeing Disney welcomed in China, despite some of the rhetoric that we've heard out of the Chinese Communist Party?
Yeah, we're very much welcomed. You know, Disney is just sort of a beloved brand. It's part of the reason that I came here. Is it truly is an iconic, beloved brand, not just in the United States, but really almost everywhere in the world. So the Chinese consumer is very much responding to what's a fabulous park experience, which, by the way, has been true in the rest of our international parks as well. Every one of our international parks made money in the quarter, and they're all doing extremely well. International parks revenue grew 35%. So I'm very, very optimistic about all the parks outside the U.S., including the park in China.
We thought people loved McDonald's and Starbucks as well, but there's been boycotts in certain places against America Inc. And you think of the Walt Disney Company, I think, as the company behind America Inc. all around the world, Hugh. How have you avoided that as a company?
It's a great question, and in all candor, I'm so new here, I'm not sure I can give you a great reason in that regard, other than the fact that as a company, what we're really focused on is just bringing joy to families, right? We're about bringing smile to people's faces, or about families coming together, and given that's who we are, I think maybe we tend to be a little bit more immune to that than most.
Hugh, it sounds like you've been there years, based on that response. Hugh Johnston, it's good to hear from you, sir. Thank you very much for being with us. We look forward to catching up with you in the quarters and the years to come. Hugh Johnston there, the Disney CFO. Lisa, a lot to discuss on this company.
Yes, I like the fact that he gave some details there about bidding separately on those sports rights. I thought that was interesting. And when it comes to, I can't speak to why Disney's been immune to it. It's just, you know, people love it. Here I am and rah, rah. I mean, look, I think that you see some of these brands hanging out there, it still is an open question.
The way they've navigated this, I think, is really, really impressive. We've got Justin Slackley with us of Shenkman Capital around the table. Justin, I know you were interested in some of the questions in that interview, some of the answers as well. How is this going to potentially upend what's happening with cable, with media over the next few years?
I thought his answers were really interesting, especially as it relates to cable distribution. Last summer, Disney and Charter got into a big discussion about including streaming rights into Charter's bundle so that clients would stay with Charter. If they have a separate streaming that just is sports, which we all know sports is the main driver today of what people are looking to watch. How are those negotiations going to happen going forward with distribution between Disney and the cable companies? It seems like that's going to be a real challenge going forward with this type of transaction moving forward.
So just to sort of put a bow on it, does this type of transaction make certain cable companies that have depended on sports revenues uninvestable?
I think it's going to be, they're going to really have to see how this plays out in the future, because Disney still needs the revenue from the cable companies. So to go totally away from them seems like an unlikely scenario. So I think a lot more needs to be developed as how Disney is going to react and how the cable companies are going to react to this announcement. Over
You
the
can
last
tell the leagues are nervous about this based on the reporting that they weren't aware, and you can understand why the companies didn't have those broader conversations. They wanted to keep it confidential until it was announced. The leagues are going to be worried about this because they'll be afraid that once you've got this joint venture, they won't be competing against each other for sports rights in quite the same way. Now, clearly Hugh Johnston's got a view on this, that they'll compete separately, and as they always have done. I'm going to be very intrigued to see the outcome, Lisa, of sports auctions in the next few years.
And it goes to the point that you were talking about, that Michael Nathanson talked about as well, which is kind of peak sports valuations right now, league valuations. Yeah, and that this could really highlight that.
The problem they've always had is that you rent the asset and that you don't own it. And the executives talk about this all the time. You spend a fortune acquiring sports rights. You develop massive production around them. You pay a lot of people to present the programs, but ultimately you never own those rights in quite the same way. So you can boost the value of the asset through your own hard work and your own investment. Then in 5 years down the road, whatever the agreement actually is, you've got to pay up even more to secure those sports rights all over again. I think that's the issue that a lot of these players have had for a long, long time. Whether this joint venture does change it or not, I'm not interested in the objectives. I want to understand the consequences. As a consequence, will they bid as aggressively as they have done in the past, knowing this joint venture exists? That's still an open question.
Because ultimately it's not going to make or break them, because their customers will keep being able to
$40 a month.
That. Exactly. Well, potentially.
What are we calling it? Spike.
Spike.
Spike of $40 a month.
Internally, isn't it? It's called Raptor, I think.
Raptor.
I like Spike.
You like Spike. Where did you get Spike from? You just made that up?
It's like very athletic.
Okay, nice. All right, let's move on. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Shares in PayPal are lower in the pre-market trade. The company forecasts little profit growth for the full year. The company's disappointing first quarter and 2024 outlook overshadowed fourth quarter earnings that beat estimates. PayPal announced last month it would cut about 9% of its workforce. It continues to trim costs and streamline its operations. Weight loss drug Ozempic continues to cause concern for snack food companies. Novo Nordisk CEO Lars Frøygaard Jorgensen said he's been receiving calls from other CEOs, adding, quote, they are scared about it. Jorgensen wouldn't disclose any names, but said the conversation centered around how the drugs would work and how fast they would roll out. Connecticut Governor Ned Lamont has unveiled plans to challenge New York State's tax rule for remote workers. New York's requires workers to pay income tax to the state if their job is based there, even if they work remotely outside state lines. The governor's plan aims to encourage residents to file suits against New York State in order to get tax refunds. Lamont says the proposal could generate over $200 million annually if successful. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on the program, making the case for credit.
If the soft landing, and this is key, can the Fed cut early enough, cut enough to get that soft landing? In a soft landing, I think you're supposed to be in credit.
That conversation just around the corner, live from New York City. This is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
DOJ or other authorities.
We could face bigger challenges.
Was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Stocks on the S&P 500 pulling back by, where are we, 0.14% on the S&P. The Nasdaq is a little bit lower as well. Equity futures doing okay. In the bond market, yields are higher by a single basis point, 413.66 on a 10-year. Under surveillance this morning, making the case for credit.
If the soft landing, and this is key, can the Fed cut early enough, cut enough to get that soft landing? In a soft landing, I think you're supposed to be in credit. You just have to be really careful, diversify the portfolio, make sure you know what you're buying.
It's the latest today. Investors weighing credit risk as Fed officials temper hopes for rate cuts. Christina Campmany of Invesco writing, quote, even with this delayed start to easing, the probability of something breaking in asset markets have diminished significantly with the easing in financial conditions. Christina, I'm pleased to say, joins us around the table. Christina, good to see you.
Thanks so much for having me in.
Start of the year, we were all told the same thing, price for perfection, and then everything started rallying. And then we were told we're priced for even more perfection, then everything continued rallying. Where are we now?
Look, I think the difference when we look at 23 and how we ended the year and 24, how we're starting, is we're exactly that, how we are priced. And I think it leaves us with U.S. assets in particular, our stretch pricing. It's hard to see a lot of enticing things there. And so when we look across the board, we find more interesting opportunities in international markets because to Priya's point that she was just making on the replay, I think stocks are at the high, IG and high yield are at tights. Like we think there are interesting opportunities outside the U.S.
We'll talk about those opportunities in a moment. You mentioned Priya's colleague, Bob Michael, I think, was sort of like the statement of the year. Jaws dropped. He turned around and said, there's not enough bonds. There's not enough bonds after what we saw last October where we were talking about whether there were too many. Are you finding the same thing? All that supply that's come through already in 2024, all that demand that's met it, are we lacking bonds, really?
I mean, it's one in one here because, again, we look at rates out the curve, long end treasuries. You had record 10-year issuance. You have 30s today, 25 billion that are getting priced. And you had record supply in January, and it seems gobbled up time and again. And I think that there's this fear in the market of missing the Fed going, and certainly from the real money community, that chasing for assets. But there feels like there's a lot of bonds in the market, you know?
Justin Slacky here with us from Shakeman Capital, who focuses on distress. It doesn't sound like there's a lot of distress, but you're still finding things to do in the U.S. Do you agree with Christina that there is sort of this push outside to look for some opportunities, or are you finding stuff here?
I think there's a lot of opportunities in the U.S. If you look at the high yield market, the average dollar price of the high yield market is 92 cents on the dollar. You can only have bought high yield below par in really crisis periods of time, except for today. And if you think about that, we have shorter durations than we ever have had in high yield. You're at about 3 duration, and we're at the precipice of a large M&A cycle. And the government has basically said we're not going to allow large cap M&A. So if that doesn't happen, that means large caps are going to buy mid-sized companies. All of those mid-sized companies live in leverage finance. And so if you can buy companies at a discount to par before an M&A cycle, that gives you a lot of capital appreciation opportunity, in addition to the fact that current yields are more like 7 or 8% right now. So I think there's a lot of opportunity in that market.
We'll get into exactly how you identify potential takeout candidates. But Christina, do you agree? I mean, is that something that you're looking at as well?
Look, I think coming out of the COVID period, you have a different historical context when you look at the default risks in all of these companies. And I'm not the credit expert, but again, when we look at high yield and IG just on the surface, I think we are at tight historical levels. That said, we have a Fed that we've had some walk back of if March is on the table or not, but I think the base case is still their next steps are easing, and that is supportive for risk assets, right? So can rich assets stay rich? I think absolutely.
You want to look international. Where?
I think the emerging markets is probably what's most interesting, and I think LATAM is probably, again, what draws some of the most focus. And
Why is that? Why LATAM?
We were having a conversation yesterday, and again, this shift from globalization to regionalization, and again, we certainly have elections in the second half of the year and the volatility that'll bring, but places like Mexico and LATAM as a whole should benefit from that. And you look at the company hiring of all of these major companies, the EYs of the world and the Amazons and all these major home company names that are hiring there, and the ability for companies to reach into those markets.
Is this a shift from China? Are we moving to Vietnam, to Mexico, to get around this China-US breakdown in the relationship?
I think that will probably be a follow-on impact, and I think either way, look, I think China is, in some sense, dealing with its own issues and have a different growth prospect than where we are in a lot of other emerging markets.
How much is all of this predicated on the rate-cutting cycle coming through?
I think a lot of it is. Certainly, but I think that those are the next steps for the Fed, and I think the Fed is still the driver of international markets and global markets, really. And I think the message from Powell, again, when we're like deep in the nitty gritty of the rates market, there's a lot of concern in this turmoil of March is off, is it May, is it June? But I think the message is the same, that we're still moving in the right direction. And I think Powell's point that he made, that it's no longer about we need to manufacture weakness in the economy, and we need to manufacture a labor market problem. We just need more confidence in inflation. So I think it's a timing issue.
Justin, how much, when you're looking at some of these idiosyncratic transactions, are you factoring in rates? How much is that part of the equation?
Yeah, I think the Fed has made rates an impossible thing to ignore over the last decade, right? Because it's really been the driver of whether it's a risk on or risk off market. When we look at rates and where the Fed is today, we just think that we're going to be here for a while. The Fed has gotten us to where we need it to be, and now they're going to slowly decrease rates over some period of time, but we're going to be more elevated than we were in the past. Wherever that winds up being, it's still going to be higher than where we were. And as a result, companies are going to have to figure out how to operate in a higher rate environment. And that's true for emerging markets, and it's true for the US. And as companies try to figure that out, it's going to be harder. And that's why you're going to have some companies do well and some countries do well, and then a lot really struggle because they haven't had to operate in an environment where there was a hurdle rate for any investment. And now there's going to be a hurdle rate going forward.
Given your thesis is really prescribed to the Fed cutting, which everyone agrees on, does it actually matter to you, though, the timing of it?
I think when you take a step back and look at 24 as a whole, no, the thematics remain the same, that we should have a weaker dollar and we should see spread compression in emerging markets and we should see steeper curves in the US. Does the timing matter of when exactly that happens? Yes, and I think will there be some shorter term cross currents of does the ECB go first, does the Fed go first, these back and forths. But I think the thematic, when we sit at the end of the year, that will be the story that the Fed has unleashed this. And even the financial condition easing that we've seen since December with that messaging shift from them.
I hear some of these conversations, Justin. It feels like the elephant in the room is the election that no one wants to talk about and everyone wants to ignore. I'm looking at Lisa.
I know.
Would love to ignore the election. Justin, can you really have a call for things like the Federal Reserve, for inflation, for growth, without a decent idea of who's in the White House and who controls Congress, given some of the policies we might see?
I think that's why nobody's talking about it, because you can have your base case, which is based on what you see today, and we know that one of the two options is chaos. That's what we had for 4 years. Every day you had to read the news because you didn't know what regulation was going to change or where the country was headed in that day. If we go that route, Fed policy, all these things are going to get wrapped up, and it could change dramatically how us and all investors look at the marketplace.
Financial regulation could shift. Deals that don't make sense today could all of a sudden make sense in 12 months' time. Lisa, we were talking about that joint venture with Disney, Warner Brothers, and Fox. Maybe the regulator is upset about that. I don't know. You'd imagine in 12 months' time, if it's a Trump White House, the regulator won't be interested.
Spirit and JetBlue will get done. I mean, here's the question, especially with all the mergers and acquisitions, how much does that kind of shift really affect where you might look or where you might not?
Justin, this was great. It's fantastic to catch up. Let's do this again. Justin Slacky there of Schenkman Capital and Christina Campmany of Invesco. To the two of you, thank you. Coming up in the next hour, the third hour of Bloomberg Surveillance. Do not miss this. Around a table with us, Richmond Fed President Tom Barkin, Bob Dole of Crossmark Global Investments, Lee Klasko of Bloomberg Intelligence. A Richmond Fed President with a lot to talk about. Lisa, the definition of what is greater confidence and how many more CPI prints do we need?
Yeah, and what is likely? What do we assign that a 21% chance?
It's going to be fun, isn't it? Sort of March, yes or no, and
exactly.
Take it from there.
Yeah.
Mike McKee's going to supervise, don't worry. He'll be with us at about 8:30 Eastern Time. From New York City, equity futures on the S&P down by 0.2%. Into the bond market, 30-year yields ahead of that auction, up 3 basis points. Your yield, 4.36. From New York, this is Bloomberg.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is Bloomberg.
What Chairman Powell told us was that a strong labor market, strong economy wouldn't preclude them from cutting rates, and I think that's still the case.
As you see from the policy speak, there is no hurry for cuts anytime soon.
That's why the Fed's pushed back. I think they have scar tissue from this inflation of the last couple of years.
Chair Powell might be having a challenge corralling everybody on the committee. I think he wants to make that first move based on a strong consensus.
The problem that we have in the market in this zombie-like economic environment where it's not discernible, you're chasing your tail.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz, together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 negative by 0.2%. Evercore's Julian Emmanuel talking about FOMO colliding with fear. Lisa, what's new about that? That's the conversation of the last couple of hours. This equity market keeps on grinding higher.
Which is the reason why people don't have a lot of conviction in it or a lot of love for it. I mean, basically, there's a question of what you get if you have volatility with potentially record gains. Does this lead to some sort of downdraft or just more volatility with higher S&P 500 targets?
Well, earnings so far are doing okay, so let's pick out a single name. Here's your single name, the Walt Disney Company. In the pre-market, up by close to 8%, 7.83% higher on Disney stock. Lisa, we spoke to the CFO about 30 minutes ago, constructive on the outlook for this company.
Yeah, pretty much across the board, the hopes and dreams of the brand and the beauty of it. He was talking also, though, about this joint venture that they're going to have and this sort of sports outlet, this point about how they're all going to bid separately, this point about how it's going to be priced, and yes, this is just a way to diversify and make it better for the consumer, but we're not trying to blow anyone out of the business or lower prices. But it raises a lot of questions going forward of exactly how this will pan out.
Well, here's the question for regulators. Are regulators going to be unhappy, Anne-Marie, with the prospect of a joint venture between the likes of the Walt Disney Company, Warner Brothers Discovery, and Fox as well?
That's one question. The second question is, will it matter depending on who wins November's election? But if you look at the mood music coming out of the DOJ and the FTC, Lena Khan in Washington, D.C., I mean, where's JetBlue and Spirit right now? That has serious hurdles. Are they going to like this kind of consolidation? I'm not sure.
Got to work out how this is even going to work. So, Lisa, it's early days, and it feels like really early days. Hadn't spoken to the leagues. They were very clear about why. Wanted to keep this confidential, understand all of that. Still need to work out a price. Still not been told a name. Just know that it launches in fall. And still don't really know how any of it's going to work from there on.
Which is curious, because it's going to launch pretty soon. So it raises a whole host of questions, none of which were particularly answered, but we do have a sense that the mood music hasn't really angered too many people, at least according to Disney, which is,
Sure.
You're hearing maybe from some certain sports leagues a little bit of
There's
concern.
one really impressive element, though, of the Walt Disney numbers, just international theme parks.
Yeah.
We've been worried about consumer confidence in China. Don't hear that about the theme park in Shanghai. We've been worried about the backlash against America Inc. What you're seeing happen to Starbucks, what's happened to McDonald's. Don't see that when it comes to the Walt Disney Company either.
And he basically is saying ongoing strength there. Putting all of that aside, and we did hear from Hugh Johnston, the sort of dream and the sort of brand of Disney and the magic of that, the magic of buybacks and share repurchases and a dividend. Really, to me, this is a notable element of this, considering that this is a feature of a number of the outperformers. They give the cash back. And this, I wonder how much this is going to be a theme as equity, cash, and interest starts to become more dominant.
If I could bottle Bremo, that segment would be it right there.
Uh-oh.
Forget Mickey Mouse. It's about the magic of buybacks and cost cuts. And let's face it, Lisa, isn't this what the likes of Trian, Nelson Peltz want to see?
I mean, yes, exactly. So how much is this a direct response to Nelson Peltz? Take this for magic. On the other hand, this is really what a lot of investors are looking for ultimately, and that's what they've been rewarding. I mean, we think about Meta. Yeah, they did a blowout quarter, but also they instated bigger buybacks and dividends. So this, to me, is really going to be something I'm looking for.
They don't want to talk about him, but they're talking directly to him. Their stock is up by something like 8% in the pre-market. The broader price action on the S&P 500 looks like this. We're negative by 0.14%. Yields are higher by a single basis point. The 10-year 4.1366. Coming up this hour, here's the lineup. Crossmark's Bob Dole urging caution as the S&P flirts with 5K. Lee Klasko of Bloomberg Intelligence on Maersk's warning for the shipping industry. And Richmond Fed President Tom Barkin calling for patience when it comes to rate cuts. We begin with our top story, 90 minutes out from the opening bell and the S&P 500 within striking distance of 5,000. Bob Dole, CIO at Crossmark Global Investments, out with a warning saying, quote, credit spreads are probably too tight relative to the risk of some economic weakness or slowdown. Fourth quarter earnings reports have exhibited modest margin pressure. Bob, I'm pleased to say, joins us now for more. Bob, great to catch up, mate, as always. Start of the year, we talked about this in the last hour. Price for perfection, then we keep on rallying. Bob, what's going to hold us back?
Hard to say. I'm one of those fully invested but biting my fingernails. Look, I don't know where the market's going near term, but I can make a few observations. Number one, every week that passes, the expectation about how much the Fed's going to cut rates gets less. Two, every week that passes, earnings estimates for the full year come down a little bit. Three, the stock market is selling at over 20 times earnings. I put those three things together and I don't know. I can't make the case for a whole lot of upside other than momentum, which is very powerful.
But Bob, you've given me an easy 4, haven't you? And you said it. 4, the stock market keeps rallying. Bob, let's talk about what we're standing on. Are we standing on the shoulders of fewer and fewer names in the stock market? And is that necessarily a problem?
Well, we saw that for most of last year. It broadened November, December. We came into the new year, and you know the story. The S&P 500 is lagging the Magnificent Seven, although there's been some fraying there. But these mega cap stocks are still working. History would tell us that as markets get narrower, the risk goes up. But it lasted for a long time last year. I think the only way we get a significant broadening is more confidence about breadth in the economy and breadth in earnings, and that doesn't seem to be the case today.
Bob, I love your description of sitting there fully invested, biting your fingernails, saying, I don't like anything about this, but momentum is a powerful freight train and I can't get against it. What would make you change your tune?
if you could convince me that earnings estimates are going to go up, that the Fed's going to cut rates as much as, look, you can't have it both ways, in my view. You can't have double-digit earnings growth, Lisa, which is what the consensus has, and have enough room for the Fed to cut rates 5 or 6 times. One of those is going to get disappointed, maybe both. So if you can tell me I'm wrong, and we are going to get multiple cuts, inflation is heading to 2%, and we're going to get double-digit earnings gains, I have no choice but to buy more stocks.
In the meantime, what's your defense? How do you play defense at a time where a lot of people say that there's an equal upside to inflation and growth as a risk as there is to the downside?
So the defense or portfolio positioning, I want quality. I want earnings predictability, earnings persistence, good cash flow multiples. What I don't want is companies where the only way I win is if the PE ratio goes up. I'm not betting on that. So I want to have that ballast in terms of earnings and cash flow.
Which brings us to Disney and the hopes and dreams of share buybacks and dividends. How important is it for you to see some dividend increase, some sort of share buyback that is announced at some of these earnings? Is that sort of a defining feature of a winning stock of quality?
Well, it is a possible feature there. I'm more interested more broadly, cash flow. Is it increasing? And yes, what are they doing with it? If they can get a higher return by reinvesting in their business rather than giving it back to me, I prefer them to do that. But where cash flow, increasing cash flow, reasonable multiple on cash flow, secondarily, what are they doing with it?
Cost cuts, that's what I want to talk about. PayPal in the pre-market is down about 9%, struggling for profit growth, forecasting little of that for 2024. And as we've heard in the last month or so, cutting about 9% of the workforce. Bob, you've talked about margins and some of the pressure coming through. Are we at that phase of the cycle now where we start to see defense of that, where we start to see more layoffs coming from corporate America?
I think so. We've already seen it to some degree in technology. Financials are picking up in terms of the number of layoffs, and a lot of that, as you point out, is a reaction to, I got to support my profit margins. Maybe I can't raise my prices like I was before, which is typical of this phase and typical more normally. Big price increases are not normal. We've had some of that because of the demand for so many things, and that's just backing off some, which is another risk to the earnings picture.
Are you more constructive on some sectors over the others and their ability to handle some of those issues?
Yeah, I think, and part of it is based on valuations, and I come back to one more time, the cash flow. I think if we get into some sloppiness, if the market fades a little bit, the financial and energy sectors, because of their cheapness, because of their multiple on cash flow, may offer some defensive characteristics. And then you got the staples, and the price increases there continue to be pretty good.
Hey, Bob, good to hear from you. Bob Dole there of Crossmark Global Investments. Good to catch up, as always. To kick off things this morning, Citi, right on cue. Bramo, when cutting 10% of the wealth employees over in London. So a bit of reporting from the team here at Bloomberg. Citi, Wenger moves to cut 51 roles across its wealth business in London as the division's new chief looks for ways to boost the returns generated by the unit. Seeing more of this, and you can say, Lisa, that it's idiosyncratic, Jane Fraser's big turnaround story over at Citi, but these stories are piling up.
And it's piling up at a time where maybe it's returned to the past, it's a normalization, or maybe this is the start of a new cycle of cost cutting. I will just say it's about 50 staffers there and about that this would affect in London. Real question, though, to me, and that's actually what I was thinking about this morning. Is this just normalization? I was looking at McKinsey, for example, and putting people on notice. Is this going back to the way it used to be before the pandemic and labor hoarding? Or is this something else? I just don't think we know yet.
The stock is down by, let's call it 0.4%. Very marginal move there in the pre-market for Citi. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Consulting firm McKinsey is putting 3,000 staffers on review as the economy slows. Employees will have about 3 months to show better performance or be asked to leave the company. More workers are facing the notice this year after McKinsey grew headcount by 60% since 2018. Similar firms announced job cuts at the end of last year, while consulting pulls back from a pandemic boom. Apple's limited release of its Vision Pro headset is prompting a hefty resale market overseas. The $3,500 device is only available in certain U.S. stores, and overseas resellers are charging a chunky premium. Some are going for more than $5,000. Apple has limited the rollout of the new headset in order to accommodate the elaborate setup and customization process for each buyer. Demand for rental properties in Manhattan has surged by 14% in January, keeping rents higher during the traditionally quieter winter period. The median price for new leases was up to 1.3% from January 2023 at $4,150. That's still lower than July's record-setting median price of $4,440 a month. New Yorkers have been seizing on the slight decline in costs from the summer peak. And that's your Bloomberg Brief. John.
Danny, thank you. Just want to go over that again, not for personal reasons, not because my lease is up at the end of this month, but rent was only up 1.3%, just 1.3%.
Yeah.
You know, just as that negotiation begins. Just want to repeat that. Rents were only up.
Hold up. No. You're going to go here. Have you fully reset from the pandemic levels?
Still working that out, yeah.
Okay, all right.
Rents have been climbing. Yeah, they've been going up loads.
Yeah.
They've been going up lots.
You're locked in. You're locked in on a COVID
Hold on a minute.
era.
Rents are up 1.3% from January 23. That's really important to know. Up next on this program, Mask is out with a warning.
What is really unclear today is the situation is unfolding. It's still actually in an escalation phase. So we have rejigged our network completely, sailing everything south of the Cape of Good Hope.
That's coming up next, live from New York. This is Bloomberg.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
We are 1 hour and about 15 minutes away from the cash open, the open about just around the corner this morning. Good morning to you all. Equities on the S&P 500 negative by 0.16%. We are up by a basis point on a 10-year, 413.27, and crude is positive by about 1.4%, $74, and let's call it 90 cents. Under surveillance this morning, Maersk out with a warning.
What is really unclear today is the situation is unfolding. It's still actually in an escalation phase. So we have rejigged our network completely, sailing everything south of the Cape of Good Hope. and expect to do that for a while until we have really safe passage reopened in the Red Sea. So this could be with us for a while.
Here's the latest. Maersk stock down hard by almost 17% in Europe. The shipping giant reporting fourth quarter earnings and guidance that fell short of expectations. Maersk is warning of a glut in the industry when the conflict in the Red Sea normalizes and inflated freight rates return to normal. Lee Klasko, senior logistics analyst at Bloomberg Intelligence, joins us now for more. Lee, let's talk about that. The inflated freight rates. Lee, you've been on top of this. You've talked about this for a while, that this just won't last. And ultimately, these freight rates are going to come back down again. Lee, what's the outlook now?
Yeah, I mean, the comments from Maersk really wasn't surprising to us. I mean, rates are up between 200 and 300% since the October lows when you're looking at, going between Asia and Europe. And the reality is the conflict in the Red Sea has been a short-term, unsustainable kind of push on rates, and when things normalize, and they will. I mean, our view is that it's going to be, we're not going to be talking years, we're going to be talking months when this gets resolved. And once it gets resolved, not only are ships going to continue, stop going around the Cape of Good Hope, they're going to start going to the Suez Canal, and that's going to actually create a lot of capacity on the market. And what the shipping industry is facing is at least 2 years of supply outpacing demand, assuming normal growth trends in demand. And that's, well telegraphed. We kind of have a pretty good view of sight of where supply is going, because it takes a long time to order and then build a ship. And so we have that data available to us. So, when you're looking at that, plus call it low single-digit demand growth, supply is going to be outgrowing demand by 200 to 600 basis points over the next 2 years. And that's going to keep rates, back to maybe not the October lows, but, to lows well below where we are today.
Lee, I want to get into supply for a moment. This didn't surprise you, it surprised someone. The stock is down by 17%. Lee, I know you don't do price targets, but can you explain that move?
Well, the reality is, since December, the stock's up 22% before today's move. So, I think the move in the stock near term was a knee-jerk reaction from these, creamy high rates. There's no doubt that these rates are fantastic, and expectations for Maersk and most liners were that they were going to lose money, and so most people were expecting, well, maybe they're not going to lose as much money, or maybe they'll even make money this year. But the reality is that's still probably going to be hard to do. Again, assuming that our thesis is right, is that this doesn't follow us through the whole year. The crisis in the Red Sea. So, probably it's going to be pretty hard to make money in this market when rates, quote unquote, normalize.
I'm really struck by the fact that what's bearish for Maersk is actually really bullish for humanity, if the idea is that we're not going to necessarily get some sort of prolonged fighting or conflicts. Do we have a sense of Maersk having any kind of inside view of this, or just, how unexpected the idea of some sort of resolution is?
Right. So obviously, peace in the Middle East is pretty difficult to get. But assuming that Israel and Hamas kind of end their hostilities, you would think that the Houthis would stop the attacks. The Houthis, the longer they do this, they're going to make more enemies around the globe. And some of their neighbors, like Egypt's suffering a lot because of the Suez Canal not being open. They're losing a lot of revenue that they rely on. And, it's impacting global trade. It's impacting China. While a lot of other countries are sitting at the sideline right now, and a lot of the interaction has been between the U.S., U.K., and the Houthis, that coalition could grow the longer this goes on. So, but what I also would say is that I am an analyst, and I'm usually like a half glass full kind of guy. The good news is that, Maersk was predicting low single-digit volume growth, so that's a good news for the global economy.
Lee, the CEO said we have not seen the level of threat peak, which makes me think, are they going to start pulling back even more ships from going through the Red Sea?
Well, the liner industry has really no more ships to pull back. The only ships that are going through the Suez Canal really are tankers and dry bulk ships. A lot of the tanker ships are carrying Russian oil or Iranian oil, so I think they might get a free pass. But other ships that might be carrying goods that are heading to Israel or maybe U.S. or U.K. goods, you'll see those ships probably divert around the Suez Canal because it's not only it's becoming dangerous, but it's becoming more expensive for shippers. Insurance rates have gone up considerably, since the activity that's been going on in the Red Sea. So it's becoming, not only you're putting your ship and your crew at risk, you're also going to have to spend a lot more money to go through the Suez. So if the conflict does accelerate and the Houthis kind of expands who they're targeting or what kind of ships they're targeting, that would have a ripple effect on the dry bulk and tanker markets, which have benefited from a rate perspective from the dislocation created by the issues in the Red Sea.
Stepping back from the issues in the Red Sea, what have you learned from Maersk in terms of shipping with China?
The reality is that China has not, kind of come out of or has recovered as quickly as a lot of folks have thought. Coming out of the pandemic, we're heading into the Lunar New Year, so there should be a seasonal slowdown. We're just still waiting for China to rev up their engines to drive that not only the export demand but the import demand of goods like iron ore and crude oil. So, China is the engine really for global shipping. As China goes, so does demand for, whether it's the container liner industry, the tanker industry, or the dry bulk industry. So, we're still waiting for them to kind of emerge from their slumber, if you will.
Lee, let's talk about where we started this conversation, which was excess capacity, too much supply. Lee, you cover an amazing industry, and I think we all remember coming out of the financial crisis, 08, 09. This was a business and industry plagued by excess capacity, ships that had been given the green light to build all hit at exactly the wrong time. Lee, why is it so difficult in this industry to manage capacity? Why are we repeating that again?
Well, there's a few reasons. One, by the time you order a ship and get it delivered, it can be well over a year. So, when things are really good, they can turn pretty quickly depending on the global economy. When the financial crisis happens, it's a snap in terms of, a decline in demand. But then you also have, not a lot of rational players. You have players that are just looking to be the biggest, or players that might be somewhat subsidized by their the governments where they reside to kind of ensure free trade. So they want to make sure that their shipping industry is robust because either they need to import a lot of stuff or export a lot of stuff. So you have a lot of players that might not be in it for a profit. They just might be in it for other reasons, and they're willing to subsidize those markets. So there's a lot of reasons, and it's gotten a little more consolidated over the years, but it's still, we would view as a pretty fragmented market because there's a lot of small players out there.
Amazing. Lee, good to hear from you. Let's catch up soon. Lee Klasko there of Bloomberg Intelligence, one of the big movers over in Europe today. They're stock down by something like 16 or 17%. Bramo, not a surprise to him, but a surprise to many, clearly, given the stock move this morning.
What I think is fascinating is so many of the headlines are saying that shipping bosses are coming out and they're warning about a prolonged conflict in the Red Sea. And you dig under the hood, and the problem with the share price is that it's not going to go on for that much longer, and they're not going to have the elevated pricing that they had previously.
Freight rates won't last because capacity is going to kick in and demand's not great. That's ultimately the story here, isn't it?
Again, what's bearish for their stock is kind of bullish for humanity. So let's hope that that's, No, I mean, seriously, you just have to wonder,
It's a point well made. I'm with you.
It just, it's hard to be like, oh, it's terrible that we're going to have a resolution to a conflict that's, been an issue. I'm just saying, I think it's interesting to see whether that is really going to be the case, especially given the potential, increase in demand.
I was taken back by the line the CEO said, saying there's no clear line of sight and when and how the international community will be able to mobilize itself and guarantee safe passage for us. Is he putting out this flag to Washington, to London, to say, you're not doing enough when it comes to these Houthi militants that have directly attacked us?
They haven't been able to restore order as much as they've tried, and the president himself has talked about it. It hasn't worked, but we'll keep on doing the same thing to try and make sure that it will work. Coming up in just a moment, jobless claims just around the corner. We'll get to that data in just a moment, and reaction from a Fed official, Richmond Fed President Tom Barkin. He joins us for the next 30 minutes. Mike McKee with us around the table as well. All of that still to come from New York. This is Bloomberg.
So the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Live from New York City, waiting for jobless claims data. Going into it, here are the scores on the S&P 500, down by 0.2% on the S&P. On the Nasdaq, also lower, negative by 0.2% as well. Going into that data, the bond market set up as follows: 2-year, 10-year, 30-year. Here are the scores for you. Yields a little bit higher on a 10-year by a single basis point. On a 30-year, up by 2 basis points. The yield on a 10-year, 4.13. On a 30-year, 4.34.52. With your jobless claims data, let's bring in Mike McKee. Hey, Mike.
Hey, John. Well, it is another good day in the jobless world. 218,000 jobless claims reported last month. Remember, we had the big job last week. We had the big jump the week before up to 224, and now we've gone backwards a little bit on that. I'm waiting to see the latest revisions to see what last week it was 227. So last week was revised up, and this week we come way down to 218. On a continuing basis, 1,871,000. That is down from 1,894,000. So it does look like workers are still on the job. Companies are still holding on to their employees.
Yield's a little bit higher off the back of this, Mike. So we're up 3 or 4 basis points on a 10-year to 4.14. On a 30-year, up 3 basis points, at least at a 4.35. You put this together with jobless claims and together with payrolls, together with ISM, services, manufacturing improving. It's pretty decent data over the last couple of weeks.
If you're looking for cracks, you're not finding it. When people say, well, just fast forward, look at the real-time data. Well, here we have the real-time data, and it's confirming the strength that we saw last Friday. The 10-year yield, I'm noting, really taking a leg higher, 4.15% rounded up. To me, that's what I'm watching. Longer term, what does that suggest about the neutral rate and about long-term momentum underneath some of the recovery we've seen?
Don't ask me, because we can have that conversation right now. Real-time reaction with the Richmond Fed President Tom Barkin alongside Bloomberg's Mike McKee. President Barkin, good morning to you, sir.
Thanks for having me here, and I am happy the data didn't surprise.
Well, let's talk about this data. Let's talk about how much weight you're putting on it. It's really strong coming out the gate for 2024. How much weight are you putting on this stuff at the moment?
Well, I think the data has been remarkable, and it's been remarkable across the board. Yeah, the fourth quarter GDP, 3.3%, the jobs numbers last month, and I think all of them do talk about an economy that's fundamentally healthy. That's a great thing. I am always cautious about numbers around the turn of the year. I mean, they're big seasonal adjustments. A great example would be the jobs numbers last month. The actual jobs were actually down 2.5 million because a lot of the retail folks who were hired for Christmas, then got laid off after. But the seasonal adjustments bring it up to a positive 353. So that's a pretty big seasonal adjustment. I look hard at it. I'm glad to see it coming in. That's the best data we have. But I'm not sure I'm going to take too much out of any one month.
Markets are obviously interested in if and when the Fed is going to cut, emphasis on the when. And I know you've said we don't have to be in any rush, but with the data like this, basically, are you telling people, we're doing fine with rates where they are?
Well, I have said you don't have to be in any particular hurry. You've got a dual mandate with employment and inflation. And the employment side of the mandate, I mean, it's actually operating at historic levels, 3.7% unemployment, job gains we talked about, initial claims
job openings. It's a very strong labor market still. And so gratified to see inflation coming down, hoping it continues to come down. And I think we've got some time to be patient.
I know you said you don't have a roadmap for rate cuts. Yesterday, Carlyle Group Chief Executive Harvey Schwartz said investors should not be thinking the Fed would cut rates 5 times this year because that would imply something's wrong with the economy. I assume you would agree with him.
Well, it's hard for me to get into the market forecast because there's always 2 elements going on in those forecasts. One is rate normalization under a healthy economy and inflation coming down. But the other, of course, is the economy takes a wrong turn and you'd come down faster. And so those things are a weighted average. To me, there is certainly a model that you take rates down quickly. That's not a model that's good for the economy. That's just one of the things that could happen. And then there's the model where you toggle rates down as the economy comes back into balance.
Underpinning this is really the mystery of the neutral rate. It's sort of this vague, mysterious concept that people throw around. Matt Lazzetti over at Deutsche Bank changed his view recently, saying that he thinks the neutral rate, instead of being about 3% in the post-pandemic reality, might be around 3.5% or even 4%. Does that jibe with your thinking?
It's certainly conceivable to me that it's come up from the estimates that we saw before COVID. The challenge with all these neutral rate estimates is the standard deviation's 200 basis points. And so the center of the S&P, I think, in the last meeting was about 2.5. So it could be 0.5, it could be 4.5. And so I think you have to sort of make your decisions not based on trying to hit a theoretical neutral, but based on what you see in the economy and what you learn about how the economy reacts to rates. And that's what I'm trying to do.
I guess as I'm watching some of the data come in and I hear from all of these investors, they're concerned about reaccelerating inflation later in the year as some of these comps change. Are you also starting to worry about that a little bit more?
Well, we've already had a lot to worry about in today's conversation, so I won't focus on all of the worries I have.
We've got more.
I saw the shipping conversation earlier today.
Lisa specialized in worry, Tom.
Yeah, no, there's a lot to worry about. Yeah. I mean, I think you have to acknowledge how good the inflation data has been for the last 7 months. I mean, the last 7 months, core inflation 1.9%. That's right on target. That's terrific, right? And I'm not rooting against inflation, but I'm always, trust but verify, let's make sure that's really right. And so we'll get a few more months. It would be, I would very much like to see that trend continue and, broaden, because it's been disproportionately goods deflation that's been masking higher than normal prices in rents and shelter. So I'd love to see it broaden. And maybe it will. The trend is good, and you can't argue with that trend. Let's just see how we go.
How do you parse inflation these days, though? Because, yes, the PCE is down below 3%, but when you look at things like the Cleveland and Dallas trimmed means, the Atlanta Fed sticky wage index, it all shows basically more inflation than your targeted index.
Well, these numbers will converge over time, right? And so what's happening right now in inflation, as I said, is you've got a lot of clawback of goods price increases that happened during COVID. And so goods deflation, which has always been a factor, is even more significant than it has been, over the last 20 years. Rents and services are higher. These trim mean measures look at the center of the distribution. And so they're looking at that center part, which is higher, as opposed to the weighted average, which is lower. If it broadens, everything will come down. If it doesn't, it won't, and we'll just see what happens.
Well, how do you make a judgment then on when you think it'll be appropriate to cut? What are you looking for? The phrase I think the chairman and others have used is measurable progress toward the 2% target. How would you define that?
If I could get these kind of numbers sustained and even better broadened, that's what I'm looking for, sustained and broadening.
There was a worry in the news conference, and you could sense that with Chairman Powell, that he wasn't comfortable yet. And I wonder if you're not comfortable either, just with this idea that maybe the improvement we've seen over the last 6 months is down to so-called one-off factors. Do you share that concern as well?
Well, another way to put it is that headline inflation for last year was 2.6%. There was a 3.3% 6-month period and a 1.9% 6-month period. So which do you believe, the 3.3 or the 1.9? So we're rounding now over those 3.3 months. January last year was a very inflationary month. So everything is leaning in terms of the numbers should be coming down, and I expect them to come down over the next few months. But let's see if they do.
It speaks to this risk that maybe we stabilize above target on inflation. And Mike, as you know, the worry is that we do stabilize above target, and if you've started to cut interest rates, you have to start hiking again. Is that a concern that you have, that if you do start to move, you're stuck in that cycle then, and you have to continue, and you can't start hiking again?
Well, you're always
trying to be cautious because you don't really want to reverse course. An interesting period to look at is 86. In 1986, after the end of the Volcker era, inflation was actually under 2%. And the Fed, which had tightened significantly, started loosening significantly. In 87, inflation basically doubled from where it was in 86, and the Fed started increasing again. So that stuff has happened in history, and you're certainly aware of that. And to the extent you could avoid it, you'd love to avoid it.
Does that weigh on you as an official, just the experience of Volcker and co?
Well, a lot of people write about the history of Fed tightening cycles don't end well, and so it'd be awesome for it to end well. But as you go study the past, it's not like you study the past and you see lots of great examples that you're just dying to duplicate.
Let me take the other side of the argument, and that is that inflation is going to keep coming down, but you're not going to move fast enough, and the economy is going to slow more than it needed to, or even go into recession because the Fed waited too long.
That's the risk you're trying to balance. And like I said, I take a lot of signal about just how historically strong the labor market continues to be, including the claims numbers we saw this morning. And so you are trying to balance the risk to the employment side of the mandate versus the risk to the inflation side of the mandate. Inflation's still elevated. The unemployment side's still very strong. I think that's how I net out right now.
We were in Jackson Hole a number of months ago. We were talking to some of your colleagues about some of the anecdotes they were hearing in their district. Remember that conversation, Lisa? Yeah. And the guidance that we were getting from some Fed officials is that what they were hearing in their district was different to what they were seeing in the data. Mm-hmm. Do the anecdotes conflict with the economic data?
Well, I'll give you some anecdotes. I was in Western Carolina earlier this week, just some things that might be interesting. One is that I saw Great Clips had a sale on haircuts for $9.99, and so that's interesting that even some services are coming down in price. That would be consistent with the data. There's a big paper mill that laid off 1,100 people in a county of 17,000, and a year later, unemployment in that county's down, not up, because there were so many openings for people in manufacturing positions that all of the people who were surplused, who didn't retire, had jobs. So that's confirmatory of a strong labor market. I think the third quarter 5% GDP stuff, that wasn't what I was hearing either, and I said the same thing. But today what I'm hearing is people aren't hiring as much, but they're not firing as much either. Price setters understand they're on the back end of the price curve. It's not over yet, but they're on the back end of it. And demand, especially on the consumer side, is still healthy.
Do you trust the data? And I say this because some of the headline data, people have been saying people aren't responding to the surveys to the same degree post-pandemic as they were pre-pandemic. Does that factor in?
Well, you have to always take data with a grain of salt. You also have to accept it's all you've got, right? And you have to be wary of confirmation bias. I like the data when it agrees with what I think, and I don't like the data when it doesn't. So when the data comes in, I take it for what it is, and I try to dig into it and understand, does it, what's behind the numbers, like the seasonal adjustments I was talking earlier. But I accept it and then try to test it, as opposed to rejecting anything that doesn't agree with my prior hypothesis.
I think that Great Clips offer was for mullets for the Super Bowl. Or so did you see anybody walking around with mullets?
You're nice to say it wasn't just because of my hairline that I got a cheap offer.
The hiring that we have seen in recent months, do you expect that? First of all, was it a surprise to see the December, January numbers? And do you expect that to continue, or are we going to fall off dramatically? And will we see unemployment start to go up to the 4.1% the SEP calls for?
I was surprised at how strong the numbers were in December and in January. December revised and in January. What I'm hearing is not as much hiring, but definitely not as much firing. That's how I put it together.
Labor hoarding?
That's sort of the technical phrase, but especially with frontline people. If you have really fought hard over the COVID era to bring people into your factory or into your restaurant, you're just loath to take the risk of letting them go and try to go into that fight again. And so on the frontline side, people are being careful. To the extent that I'm hearing anything on job cuts, it's actually the professional side. It's overhead. In your business, maybe your pricing power isn't going to be what you thought it was going to be. You're worried about the risk on the operations side to laying off operating people. Well, let's take a look at our overhead and thin it. That's where you see it. And some of the jobs announcements you've seen recently, I think, disproportionately look like overhead as opposed to frontline.
Interesting. Seeing a lot of that this morning as well. We've talked about those companies too. There was a moment in the news conference last week where Chairman Powell was asked about the month of March, and it felt like that kind of off the cuff, he just got freezing cold water and poured it all over March. We're trying to work out whether that was Chairman Powell's view or if that's the general view of the committee that you share as well, that perhaps March is just too soon.
Well, I don't ever prejudge a meeting, and I don't prejudge the March meeting. We'll see where we get. But I always think Chairman Powell speaks for the committee.
He was talking about the balance sheet too, and that sounded much more interesting. If they're not going to cut interest rates, maybe they make a decision about QT collectively, the committee, you. Can we talk about that? The decision that you've got to make, is it independent of the interest rate decision for you? What happens with the balance sheet from here? Can you do one and continue with the other?
Independent of the interest rate decision, because you're talking about normalizing, and when is the right time to start normalizing rates, and you're talking about normalizing the balance sheet. So we're still in the process of doing that. As Chairman Powell said, we'll have a conversation about it, and I think it's great that we do that because you want to plan what you do. I still haven't seen any signals that we're closing in on the level of ample, at the end of the ample reserves regime. Just a number that keeps hitting me. If you add up the overnight RRP plus the reserves today, we're still over $4 trillion. And if you look at September 2019, we were in the 1.2, 1.3 trillion in reserves without an overnight RRP and without a standing repo facility. So I think we're a pretty long way from where we were then. And, times change. We'll see where we are. We've got to learn more. But I still think we're a long way from where we were then.
You know where I'm going, because you do hear people say that if you start cutting interest rates, but you're still doing QT, they're sort of running in opposition to each other. Do you not see it that way?
Don't.
We'll leave it there. Tom, we're going to stick with us. Tom Barkin, blunt and to the point. We appreciate it. The Richmond Fed president is going to stick with us. Let's get you up to speed on some top stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Citi is weighing a move to cut 10% of its wealth employees in London. That's about 51 positions. According to a memo seen by Bloomberg, Citi's wealth business is, quote, continuing to identify areas to improve efficiency through structural changes and cost-based reductions. Citi is in the middle of a vast restructuring that will see the bank cut 5,000 jobs before the end of this quarter. Shares of Ralph Lauren are rising after its third quarter earnings beat estimates. The company saw total comparable sales up 9%. That's almost double what analysts had expected. Ralph Lauren CEO says the results, quote, exceeded our expectations, led by continued momentum in direct-to-consumer channels. The U.S. Supreme Court will hear arguments today in a case which could decide whether Donald Trump can be excluded from ballots. Lawyers are expected to argue that his involvement in the 2021 Capitol Hill insurrection violates the 14th Amendment. Trump's defense will argue this provision doesn't apply to a former president. If Trump were to lose the case, he could effectively be barred from holding the presidency again. And that's your Bloomberg Brief. John.
Hey, Danny, thank you for that. Up next on the program, banking crisis concerns creeping back in.
I do have a concern about commercial real estate. If it's manageable, although there may be some institutions that are quite stressed by this problem.
That conversation continues just around the corner. In the equity market right now on the S&P 500, equity futures negative by 0.1%, yields higher by, let's call it 4 basis points on a 10-year, 414. Jobless claims come in lower than expected, 218 against an estimate of 220 from a beautiful New York. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Minutes away from the opening bell in New York. Equities doing okay. We're negative 0.1% on the S&P. Yields a little bit higher following better than expected jobless claims. The right kind of downside surprise, as we like to say. Yields are higher by 2 or 3 basis points on the 10-year, 4.1463. Under surveillance this morning, banking stress concerns creeping back in.
I do have a concern about commercial real estate. Commercial real estate is an area that we've long been aware could create financial stability risks or losses in the banking system. And this is something that requires careful supervisory attention.
Here's the latest this morning. Investors looking for signs of financial stress after fears in commercial real estate sent shares of New York Community Bank plunging to a multi-decade low. The pain also found in Europe and Asia as banks across the globe prepare themselves for potential losses in CRE. Richmond Fed President Tom Barkin with us around the table this morning together with Bloomberg's Michael McKee. Tom, it's fantastic to continue this conversation. The worries of the banking sector of last year, different this year. Last year was about working through interest rate shocks. Now it's about potentially credit stress. Is this coming up on the committee? When you saw that in NYCB last week, the day of the decision, is this something you all talked about together collectively?
Well, commercial real estate, as the Secretary said, is a known issue, and it's an important issue. I was in D.C. yesterday doing a roundtable with some real estate executives. That's a market that struggled to come back, and you can feel the stress in the commercial real estate area, particularly, of course, downtown office. So that's a real thing, and the banks, many banks and non-banks have exposure to that. That's an important thing to take into account in terms of stability. But as I say, it's not a new kind of risk. I mean, we have had real estate shocks before. We've gone through real estate cycles. It wouldn't stun me if, a bank or two ended up wrong-footed in those things. But the system knows that real estate is a, asset with a certain amount of risk, and I hope and expect that, we've got enough capital to weather that.
A lot of people have speculated that the Fed would cut rates in response to another bank failure. Do you think that that's an accurate assessment, or do you think that that is not the correct channel of response? Because that's basically what's baked into the market, a lot of people are saying.
Mandates, employment, and inflation, you've got to take into account what you think is going to happen to employment and inflation. If the economy is to turn south, I mean, that's a case for trying to normalize rates faster, but the economy would have to turn south, as opposed to this being some sort of a bank oversight response.
The chairman said that this is a manageable problem, commercial real estate, but I want to ask if you think that in the context of Fed officials, including the then chairman, telling us in 2007 that real estate was not going to collapse.
Sorry, and your question is?
Do you have a good handle on this? Can you be sure that this is something that's manageable?
Well, in the banks that we supervise, I mean, we're spending a lot of time with them and productively going through the real estate assets and trying to understand what the risks are and what the reserves are against those risks, and making sure we've got those things appropriately handled. So in the scope that we've got, we're working hard on that. I think you never know what you don't know. And so, what might happen in the non-bank sector, don't know. What could happen, with these real estate assets, we'll see. But I think we've got our head down with the banks that we oversee, trying to work through it.
Well, does this weigh on your thinking at all about when you might want to cut interest rates? The story that the real estate people tell is that this problem is only going to get worse over time as companies get closer to their refinancing.
I think it's important to take commercial real estate apart. I mean, there are huge parts of commercial real estate that are quite healthy. Data centers would be a good example. Retail is healthy. At least the holding part of multifamily, the building has its issues. We're really talking about office and a narrower, B and C downtown office space. That's where the biggest risk is. And I'm sure there will be losses, and already have been and will be losses in that space. But as I said, it's a known variable. If you go back to our stress test assumptions, you'll see pretty significant stress on commercial real estate valuations, and you saw the outcomes for the bank. So
There are a lot of known variables out there, which is the reason why we're so worried. And you said there's a lot of worry around this table. We were worrying earlier with a bunch of credit people who are no longer worried because somehow some of these maturities are not an issue. How do you understand the fact that people were talking about zombie companies, they were talking about zombie real estate, they were talking about how the world was going to be turned on its head when the Fed raised rates by 5.5 percentage points? How do you make sense of the fact that that just hasn't happened?
Is it possible that some of them were wrong? I'm just not sure. But if it's not that, if it's not, here are the numbers that have really spoken to me, which is if you look at the total interest burden for individuals and the total interest burden for companies, and you divide that total interest burden today by total revenue for companies or total personal disposable income for individuals, the numbers have finally now, in the aggregate, just gotten back to 2019 levels. And so what does that mean? There are a lot of people, individuals, who refinance their mortgages or pay down their credit cards. There are a lot of companies that refinance. Absolutely companies that are wrong-sided, wrong-footed in this. But in aggregate, this total interest burden hasn't yet hit the country in that scope, I think, that a lot of people predicted. It could. I mean, that's a good reason to be cautious on the economy. On the other hand, the continued month-over-month health of demand, look at GDP for the last half of last year, sort of argues against it. But that's what you watch.
We've got about 2 minutes left, which means we should probably talk about something you definitely don't want to talk about, which is politics down in Washington. When senators and officials in Washington start to write letters to the chairman to ease policy, how does the committee respond to that? It's a big election year. You talk about live meetings. We're wondering how live some of the meetings are going into that election. How do you avoid getting into politics?
Listen, I think the chairman was brilliant on 60 Minutes, and if you watched it, he sort of closed with a very clear answer to that, which is we just try to do the right thing, and I think his phrase was integrity is priceless, and I thought that was very well put.
The chairman on 60 Minutes also talked about the urgency of the fiscal health of the country. CBO yesterday, debt will hit a record high. So much of that is for net interest payments. Is that a reason to potentially cut rates?
I assume you'll have other people on and ask the question of whether it's to cut debt. I mean, there's two ways you go. I think we're trying to focus on inflation and on unemployment, and I think having rates be in restrictive levels is good for the long term. And if we can get inflation down to where we want to, and if employment can stay in the right place, rates can normalize, and that'll reduce that burden. But our objective function is not around the country's debt burden. Our objective function is around what Congress has asked us to do, which is inflation and unemployment.
Tom, it's good to see you. Thanks for catching up.
Thank you for having me back.
Appreciate your time, as always. Richmond Fed President Tom Barkin there, alongside Bloomberg's Michael McKee. To round out the program this morning, just a brief look ahead to tomorrow. Jay Pawlowski of TPW, Thomas Kennedy of JP Morgan, Dana Peterson of the Conference Board, and U.S. Air Force veteran David Depchler, now of Academy Securities. Bramo, a lot to talk about with that crew.
Yeah, especially if Maersk sees it resolving, at least in the near term. Let's hear what he has to say with respect to the Red Sea.
34 minutes away from the opening bell. Equity futures negative here by 0.1% on the S&P 500. From New York City this morning, good morning to you all. This was Bloomberg Surveillance.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to
startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
From New York City, for our viewers worldwide, I'm Menace Crenny, in for Jonathan Farrow. Just looking at these markets, smelling the 5,000 line. You've got a whole new world for Disney, and you've got tech on fire with ARM. But we are prevaricating at the 5,000 mark. Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up on the show, futures fluctuate. The rally that drove the market to fresh all-time highs. The bond market faces its next big test, another auction. And ARM and Disney impress investors. We begin with the big issue. The Fed preaching, you got it, patience.
You have to acknowledge how good the inflation data has been for the last 7 months. I mean, last 7 months, core inflation 1.9%. That's right on target. That's terrific, right? And I'm not rooting against inflation, but I'm always, trust but verify, let's make sure that's really right. And so we'll get a few more months. It would be, I would very much like to see that trend continue and, broaden.
It's about the breadth of the good news. Joining me now to discuss the Fed and more on markets, it is Morgan Stanley's Vishy Tripatur and Mona Mahajan at Edward Jones. Mona, I mean, it's tantalizing, isn't it? 5,000 on the S&P 500. We are on fire. Risk is on fire. Can we live long and prosper without 5 rate cuts as far as risk in equity markets is concerned? Good morning.
Good morning. And yeah, it's a great question. Look, we've looked at what happens when January is higher. There's that old saying in the markets, so goes January, as goes the year. And so January was up about 2% in the S&P 500. When we look back since 1950 years, there's been 44 years when January has been higher. 39 of those have been followed by a positive full-year return, and positive by an average about 18%. So while history may not repeat itself, we certainly have a precedent for January leading the market for a full-year gain. Now, all that being said, we're looking at the fundamental backdrop, probably more so. And this year, we are facing an environment where the Fed will likely pivot to rate cuts. We are seeing inflation continuing to moderate. And by the way, we have an economy that's holding up pretty nicely. So we think those combinations combined could lead us in a better direction. Now, keep in mind, we have had a very strong move, 22% higher since that October 27th low in the S&P 500. Could we be due for a period of consolidation or pullback? Yes, absolutely. But we think that the Fed is likely to cut rates probably in that 3 to 4 time range, or 3 to 4 cuts range that they have been telling us and that we think could lead to better outcomes ahead.
Okay, still in there for the 3 to 4 rate cuts. Vishy, good morning, good to see you. We'll talk more about Barkin and the Fed in just a moment, but if I look at the bond market, 414 is where we are on 10s. The truck has been backed up ever so slightly. So my question to you is, we've shown up to buy paper this week in 3s and 10s. Does that continue for 30s today?
I would expect that. I think if you look ahead, we expect to see 4 rate cuts of 25 basis points each starting in June over the course of this year. And we think both from a technical perspective and a fundamental perspective, this sets up the duration to be in a really good place. So we would be constructive on duration going forward. I don't want to get too caught up in the sort of the day-to-day, week-to-week changes in the level of rates. But I think the underlying conditions are that we are looking at a Fed that is going to be easing policy, cutting rates, not only in 2024, we expect more cuts to happen in 2025. So on the back of that, we think that the outlook for duration is pretty solid.
You're beginning to sound like the Federal Reserve there in terms of not getting caught up in the minutiae of the day-to-day. But we can, of course, dig into the day-to-day. The Richmond Fed President, Tom Barkin, sat down and spoke to the team. Mike McKee led the conversation on this growing chorus of officials tempering our hopes for rate cuts. Mike, good morning. Good to see you. Great conversation with him. He just didn't take the bait on a couple of occasions. He likes the narrative on inflation, but it's got to broaden for him, doesn't it?
It has to broaden out. He does agree that they have met their mandate on employment. And you look at jobless claims this morning at 218,000, lower than anticipated, going in the opposite direction of last week's big jump in jobless claims. He says that the labor market is in very good shape, and what Tom Barkin has noticed from the CEOs in his district is that people are slowing their hiring plans, but they are not letting people go. It was so hard to find workers that right now companies want to hold on to people, and the layoff notices we're seeing basically are a trimming of overhead, not of production kind of workers. So as you mentioned, put him in the camp with the others that we've heard from over the past week. 9 Fed officials, hadn't even been a week, basically. 9 Fed officials, all of them saying later this year, basically pouring cold water on the idea of a March rate cut. And even May is iffy at this point. They all want to see, as Barkin said, inflation coming down and the disinflationary effects broadening. Now, there was a warning for the Fed in yesterday's testimony by Janet Yellen up on Capitol Hill, the Treasury Secretary. She's going back up there today. She told people yesterday commercial real estate is an area we've long been aware could create financial stability risks or losses in the banking system, and this is something that requires careful supervisory attention. Tom Barkin endorsed that latter part, the supervisory attention, saying it's not something you necessarily want to cut rates over, but he did say we will see continued problems, continued losses in commercial real estate, particularly for offices, but it should be a manageable problem and that they are on top of it and they're working hard with the banks to make sure there's no systemic issues.
I like the phrasing that he used. Instead of losing a bank or two or a bank or two going under, he said a bank or two may be wrong-footed, but of course it depends the scale of the wrong footing. I've tripped a few times in my life, and some of them can be pretty bumpy crashes. Mike, thank you very much. Mike McKee with the Richmond Fed. Mr. Barkin, Vishy Trupatur and Mona Mahajan are my guests this morning. Vishy, let me take it to you. It's interesting. Barkin talks about reminiscing 1986. Inflation was 2%. 87, inflation doubled. The Fed had to hike rates. This is the ghost. This is the ghost that haunts them, isn't it?
Indeed, I think the way we would look at it is, how much of we have clear evidence that the clear evidence of deceleration in the pace of inflation. So on the face of that, on the back of that, if you look at how much of restrictive monetary policy, how much of restriction is required in the economy, and if the Fed doesn't do anything, it just stands pat where they are, we are adding more restriction to the economy, and how much of that is required, and for how long. I think that's the crucial judgment that the policymakers will have to make. And we think that the extent of the restriction that is required would no longer be needed. We think that timing would be around the June timeframe, and there was some risk of a May. But we think really our base case remains June. We think the real question is how long the economy needs to be run at this increasingly restrictive monetary policy. And our response to that is that it doesn't. Therefore, the motivation for the Fed is not really to stimulate the economy, but simply to move back the monetary policy into a more normalized monetary policy.
So, more normalized monetary policy, you say the sweet spot is 3 cuts at 4. In a sweet spot environment, where do I want to be most exposed in the equity market?
Yeah, it's a good question. And, just to broaden that Fed conversation out, if they do 5 to 6 like the market expects or more, we could be in an environment where the economy is moving more south than we would like, and that's why they need to cut more. If they went 2, 1, or 0, it could mean that inflation has started
Are you seeing any flashing lights that concern you about that? I looked at delinquencies yesterday. I look at some other credit card. I look at the amount of leverage in the system. The savings are dropping off. I mean, if you put them all together as a concertina, there are some amber lights.
Yeah, I think there is a case to be made that the economy could slow from a very high pace of gains. We've seen 4.9% in Q3 and 3.3% annualized GDP growth in Q4. That is above trend growth. Could we slow to what we're calling sub-trend growth of 1.5% to 2%? Yes, but we're not yet seeing the signs of any sort of downturn or negative growth in the economy. So we think a period of sub-trend growth could be likely, but by the back half of this year, given rates may be lower, inflation we think continues to moderate, we could see better trends ahead. And so to your point on where do we invest in that environment, well, we do think there is a broadening of leadership that probably plays out in the next 12 months or so. Last year was very much the year of the Magnificent Seven, the mega cap tech trade, and the year of cash and CDs. We think this year we see, you don't want to wholesale give up on the AI trade. It isn't a long-term secular bull market, but you want to complement that with parts of the market, the S&P 493, as we like to say, but cyclical parts of the market, even across the cap space. Think about the mid-cap space, which could play some catch-up. And then to Vishy's point, investment-grade bonds, continue to remain attractive here. Not only can you lock in some of those better rates for longer, given the longer duration, but the potential for price appreciation is still there, we think. So balanced portfolios, we think, will be the theme this year versus very concentrated, narrow portfolios of 2023.
Yeah, I mean, there were certain just real sort of hooks to hang our hats on last year. Vishy, you also would say that the Fed will cut the pace of QT. Now, can you co-join that pace of cutting QT with rate cuts? Do they jar against one another, I suppose, is what the market will ask?
So we think it's the pace, what we'll call taper. We think that the likelihood that the tapering of the QT, the quantitative tightening, will begin to happen sooner than what might be what we thought some time ago and what might be in the market's expectation. A taper it would mean I think the idea of an earlier start to taper is to be proactively manage any potential challenges that come in the funding markets. So we think a taper is probably going to happen, an early start to taper going to happen. And a taper doesn't necessarily mean end of QT. So a taper, actually, an early start to taper could actually mean the quantitative tightening, the balance sheet coming down could actually go longer, but happens much more orderly to prevent challenges cropping up in the funding markets. So we think that the QT will end. Our base case remains that it will end sometime in early 2025. But this moving the taper forward, we think will help mitigate, at least address some of the potential challenges that could be there in the funding markets.
From your side, Mona, what does a shift in QT mean?
Yeah, look, when the Fed Treasury was bringing a lot of Treasury bonds to auction in 2023, in fact, over $3 trillion worth. And there was a concern that the demand side wouldn't be there. And of course, that was because the Fed was no longer a key player in the market. They were implementing a very strict QT. We saw foreign economies, maybe there was a thought that China was not buying as much Treasury, although we saw an offset by the rest of the world. Keep in mind, even at 5%, at 5%, a U.S. Treasury to the rest of the globe looks pretty attractive. But as we think about the environment moving forward, that $3 trillion of Treasury auctions only going to move higher. So you need the demand side of the equation to be there. The supply side is going higher. And so if the Fed does taper its QT, as Vishy suggests, we think that means that the Fed is now at least somewhat in the market, a buyer of Treasury bonds once again. That puts a little bit less pressure, upward pressure on Treasury yields overall. And that's really the goal of what they're trying to achieve here. They want to get gradually towards a more neutral level of Treasury yields of a Fed funds rate. And I think the combination of lowering the Fed funds rate gradually plus eliminating QT gradually over time as well puts that downward pressure on yields and gives us really a better balance in the Treasury bond market overall.
And that lowering of rates here in the United States, Vishy, just to talk about beyond borders for a moment, you are tempted towards emerging market debt. Any region in particular?
I think the opportunity set is somewhat better. Still remains the U.S. over the rest of the world. That remains the case. But I think there are pockets of higher quality emerging markets. You know, the investment grade part of the emerging market is what we will find the sovereign credit risk to be more attractive. So we'll still, even within the emerging market world, we will lean towards the higher quality end of that.
Okay, that is a fairly complete conversation on these markets. Let's see, I thought Barkin really did hang on to the 1986 redux and the risk to 87. Vishy Tripatur and Mona Mahajan, thank you very much for being with us. Let's look under the hood ahead of the opening bell. Katie Greifeld is with me. Katie, what have we got?
Let's start with PayPal because it is plunging pre-market. Of course, it reported and it issued a disappointing 2024 outlook, which Wells Fargo said would, quote, vindicate the perma bears. Certainly seeing some vindication this morning. You have Disney, though, dominating. First quarter earnings beat expectations, gave a full year profit forecast that was seen as strong. The international parks business as well also showing strength. It also boosted its cash dividend by 50%, said it's targeting $3 billion in buybacks this year. That's good for 8% pre-market, and we have to talk about ARM. It is absolutely soaring, the chip designer. It beat mightily. It also gave a bullish outlook. This company has been pushing beyond smartphones, and that's paying off. The stock is up almost 27% pre-market.
Okay, Katie, thank you very much. That is quite literally ripping high. Breaking news in the past 20 minutes. Saudi Arabia is said to tap Goldman and Citi for You Got It and Aramco share sell. Get ready. That conversation coming up on Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
of breaking news from Saudi Arabia. They're set to hire Citigroup, Goldman Sachs and HSBC for a secondary share sale in the oil giant Aramco. Take your mind back. Of course, they are now set to raise $20 billion in what could be one of the biggest offerings in the IPO market recently. Matthew Martin is with me in Saudi Arabia, staying late to break this news. Well done with you and the team on this Bloomberg scoop. Put it in context. They raised $30 billion a couple of years ago. It was all about the dividend. Here we go, $20 on the line. Are we going to be queuing up to buy this, Matthew? Give me the details.
Yeah, look, as you say, this is a follow-on transaction from that offering in 2019, which was the world's biggest IPO, raising around $30 billion. Since then, the government still holds a 90% stake in Aramco. There's another big 8% stake held by the Sovereign Wealth Fund. The government said it's going to reduce that stake as it looks to raise money to fund this huge economic transformation that it's been embarking on, and fund plowing all these money into all these sports deals and into all this investment that's going on around the world and domestically as well. So now it seems like we're very, very close to the government pulling the trigger on a second offering. It's got the banks involved now. It's got Goldman, as you say, Goldman, Citi and HSBC lined up for a secondary offering. We expect that they will, if they do decide to go ahead with an offering very soon, then there will probably be more banks added onto this.
Tell me how hard.
Remember from 2009.
Yep. Tell me this. To get this away, Matthew, in a post-COP28 environment, Saudi Arabia has just reduced the amount of production target for themselves. So this is about monetizing the asset, I presume. But are people going to be queuing up? Is this going to be such a massive coverage? The world is different to when it was first IPO'd.
Yeah, exactly. Even in 2019, it was difficult. It was a tough sell in a world increasingly worried about ESG, and also looking at Aramco as not being as having the high returns that you get from some of the other oil majors around the world. Now, what they've been trying to do since then is they've been trying to address this. They are there's a new mechanism so that they can pay out higher amounts of cash flow to shareholders in the future. Okay. They're investing a lot into going into other areas downstream, investing into renewables, investing into hydrogen to try and say that this is not just entirely an oil play. The thing is as well, the challenge in that story is, of course, that there's still 9 million barrels a day pumped of oil. It's still the biggest single producer in the world. So the majority of the Aramco story is going to continue to be crude oil production for a long period of time, even as they try and shift that narrative. And the other challenge facing them is going to be that in 2019, I mean, every investor under the sun was called and offered Aramco, and a lot of people decided not to take it then. The question is going to be, given a second chance, what are they going to say? Are they going to want to go for it now if they didn't go for it in 2019?
Well, perhaps we get the chance to ask Amin Nasser himself in Miami in a couple of weeks' time. So your job now, very clear, just get us an interview with Amin Nasser. I'll be there. You can get the flight, get the air miles. Matthew Martin in Riyadh, staying late, breaking the news with the Bloomberg team on Aramco. There is one other company this morning that is the talk of Silicon Valley. ARM, semiconductor surging, delivering a bullish forecast, showing its push beyond smartphones is helping fuel growth. CEO Rene Haas says, quote, "We are involved in just about every single end market, and just about every single market is putting more compute into their devices." Katie Greifeld sums it up short and sweet. Good morning, Katie.
Yeah, you look at ARM right now, it's absolutely flying. To get into the numbers here, the chip designer said yesterday that revenue in the 3 months ending in March will be between $850 to $900 million. Analysts were looking for $778 million, so that is a huge beat there. The company also said that earnings will be roughly 30 cents versus expectations of 21 cents. And that rosy outlook really suggests, to your point, that ARM's expansion into new markets is bearing fruit. The chip designer has been pushing beyond smartphones. Those account for about 1/3 of the company's sales, and we're looking into areas such as server chips. And if you take a look at their customer list, it really spans the entire tech industry. We're talking about Apple, Amazon, Qualcomm. They all use ARM's designs in some capacity here, and that diversification really paying off in shares this morning. You can see shares currently up about 27.5%. If that holds, it'll be the biggest one-day gain since its IPO.
You know what I'm praying is that there's a bit more ARM in that ESG portfolio that they've got for me than Tesla. Katie, thank you very much. Katie Greifeld there with the very latest on the tech moves. And be sure to tune into Bloomberg Technology today, 11 a.m. Eastern Time. The ARM CEO, Rennie Haas, will be with the team. Now, it's important day 2 of testimony. This is a live shot of the U.S. Treasury Secretary Janet Yellen. She is testifying at the Senate Banking Committee Financial Stability Oversight. Now, in her prepared testimony, she talks about what they're doing to maintain confidence in the banking system.
Cybersecurity information, including through ongoing partnerships between state and federal agencies and the private sector. Fourth, the Council is closely monitoring the increasing use of artificial intelligence in financial services, which brings potential benefits such as reducing costs and improving efficiency.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
What can we punch out today? We managed to deliver 2 record all-time highs on both NASDAQ futures and the S&P 500. This is a big psychological blockbuster for the market. We have 10-year paper being gorged on yesterday. Will they turn up in size for the 30-year auction today? There we go, NASDAQ 17,823. Let me get you up to date with some of your morning calls. This is what we've got. First up, Barclays upgrades Roblox to equal weight. PT, $46. Company has robust fourth quarter earnings. Next up, Wedbush downgrades GoPro to neutral. The price target there, $2. The analyst saying margin expansion opportunities are limited. And finally, Needham upgrading Disney to a buy. I love this. A whole new world under Bob Iger, expecting earnings growth driven by the company's streaming business. There is a world. Coming up, John Stoltzfus joins me very shortly ahead of the opening bell.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Great World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Brought dogs to the nicety. This is a pet adoption company. There you go. I love it. I love it. They're always clapping more at the NASDAQ. Why wouldn't you? These are new all-time record highs. Yes, you might have a bit of a dip of red on the blood on the screen this morning. 5,012. 5,000. We haven't seen that level before. It's a big psychological level to break through and sustain the momentum on the upside. You're clearing through this earnings season. Is it robust enough to take you higher? There is the opening bell. Let me roll it over. By the way, you've got a difference between Walt Disney and, of course, ARM. Tech and consumer enjoyment are the bulwarks of this market. Euro dips by an eighth of 1%. The dollar remains king dollar in a strong economy. 10-year yield 4.14. 30-year bond auction coming down the pike this evening. Will they turn up in size to buy it? And crude is up by 1.67%. Why? Why is crude taking a buy? We're up over 3% in the past 3 sessions. It's the longest winning streak since September. Soft landing, strong economy, take your choice, but they're not worried about geopolitics just at the moment. Disney, one line, Bob Iger, he delivers. That is the most important thing in this media company, giving a strong profit forecast, cost control, performance of the parks overseas. Katie Greifeld takes me to a whole new world.
Lights out report for Disney, like you said. Let's go through some of the numbers right now because earnings rose to $1.22 per share. Analysts had been looking for 99 cents, so a big beat there. Revenue was a little changed. They did have some misses at the box office, but the profit outlook was quite strong. Disney said that thanks to cost cutting, profit will rise at least 20%. So there you have it. And let's talk about streaming as well. Of course, a lot of focus on the streaming business. Company did say that subscribers to Disney Plus, they did fall to 149.6 million in the quarter. Analysts had been looking for 151.2 million, but Disney also said that it expects to add as many as 6 million subscribers this period. And importantly, losses, they shrank to $216 million. For context, we were talking about losses of more than $1 billion a year ago. And the company also said that it predicts that its streaming operation will reach profitability by the fourth quarter of this year. Of course, there's a lot of focus on that date. They're well on their way there. And also some news from last night. Disney announced it's buying a $1.5 billion stake in Epic Games. And we should probably mention that international parks saw sales increase 35%. So you add it all up, and it was a strong showing from the House of Mouse.
Indeed, the House of Mice. I love it. Katie Greifeld there with the very latest on the House of Mice. Turn to fintech. PayPal forecasts little profit growth this year and says it continues to cut costs. Isabel Lee has the story. Down 7.82%. Isabel.
It's down 7.8%, Mattis. And earlier in pre-market trading, it was down more than 9%. And when the market opened, down 10%. That's on track for its worst day since August. Investors are really spooked by PayPal's disappointing 2024 outlook. PayPal said it expects earnings to be flat this year. It announced last month it will cut its workforce by around 9%. The company blames its streamlining operations and its cost cutting as part of the measures it will impose. Its CEO in November said that PayPal's slow progress is really because of its cost-based and complex structure. But fourth quarter revenue and earnings, though, beat expectations. Volume climbed 15%, beating analyst expectations. We also have adjusted earnings, topping forecasts. And for 2024, the company also expects adjusted earnings of $5.10, which is unchanged from their previous estimate. Wells Fargo said this will vindicate the perma bears, but most analysts are questioning whether PayPal's big transition plans will translate into an actual growth. And here's also something interesting. PayPal said it will drop issuing annual revenue guidance and instead will do a quarterly one. Its CFO said, "We are just doing too many things, Manus." Shares now are down almost 8%.
Yeah, the perennial argument against the quarterly reporting. Isabel, thank you very much. Let's turn our attention to the chips market. ARM giving a surprisingly bullish forecast, expanding beyond smartphones. Ed Ludlow is in San Francisco. It's a blistering performance by ARM, up 33%. This is AI writ large, isn't it?
It's AI writ large, and those gains accelerating out of the open. It is the biggest jump on the stock since they listed in mid-September. They're easily breaking through to fresh record highs. But you're right about the story. The numbers speak for themselves, right, in terms of forecasting sales of $850 million to $900 million this year, way above the street estimate of $778 million. The story is that ARM offers two separate services. One is the blueprint or building blocks for chip design, of which it charges on a royalty basis. The other side is that it offers the code that allows a semiconductor to communicate with the software that runs through it on a licensing basis. And what they showed us was evidence that they have moved away from smartphone in both cases. Smartphone is the history of their business. It's now just 1/3 of revenue. On the building blocks blueprint side, the latest iteration of their technology is V9. That carries double the royalty that prior generations of those chip blueprints used to carry. There's evidence that they're selling those and more cores to non-smartphone design centers, for example, what Microsoft is doing in server chips. I'd also point our Bloomberg audience to the terminal and online for the reporting about SoftBank overnight. SoftBank still owns 90% of ARM, even since the listing. And it recorded its first profit in 4 quarters overnight. But the narrative was very much, ARM is our big bet. It is our baby, and what we're going to do is position ARM as our main AI play. So when I speak to Rene Ass, the ARM CEO, in a couple of hours' time, I guess that's the question. That you have a parent company, to all intents and purposes, that sees you as its crown jewel and wants to be calling the shots. What do you think they'll do as part of that strategy?
Yep, well, it depends how much independence he wants in terms of thought process and strategy. Ed, good luck with the interview. We look forward to it. I'm sure we will listen to it acutely. Rene Haas, the CEO of ARM, joining Ed and the team at 11 a.m. Eastern. Let's pivot to airlines. Spirit is fighting to preserve its acquisition of JetBlue. It reported a smaller fourth quarter loss than was expected. Natalia Knežević joins me with the very latest. So today it's about the numbers for Spirit, isn't it, Natalia?
That's right. Numbers and guidance, of course. The stock is up by 4%. Adjusted loss was $1.36. It was better than analysts expected. Expectations was for $1.41 a share. Revenue came in line with expectations, and the company said that capacity for this year will be flat. But numbers for the last quarter were mostly given, and of course, guidance was the most important. Guidance was positive, or in this case, I should say, less negative than some people had expected. Well, first of all, Spirit expects an operating loss of $171 million. Expectations were for $200 million loss. And maybe the most important part here is that it expects a positive operating cash flow in the second quarter and throughout this year. However, Citi analysts are saying, we know that Spirit has debt that matures, $1.1 billion debt that matures in 2025. And there is a very low visibility between this debt obligations and cash flow in 2024 and 2025. 2025. And of course, finally, we know that Spirit is trying to get this deal done with JetBlue, and the next key milestone is in June. That is when we will have hearing, and that is also when this offer from JetBlue will expire, Manus.
Okay, Natalia, thank you very much with the very latest on Spirit Airlines. Coming to breaking news headlines coming from the Treasury Secretary, who is on Capitol Hill today, Janet Yellen, as you can see in front of the panel. She says the U.S. needs to reduce its deficits to reach a sustainable path. There's no sign of issues with the Treasury's debt selling ability. We saw that this week. We saw this with the 10-year government bond auction this week at a record $42 billion. And in an extreme case, it's possible to see issues with selling debt, but not for the moment. That is the Senate Banking Committee that she is in front of at the moment. We'll keep an eye on that because the debt, the trajectory of debt in the United States of America, the servicing of the debt in the United States of America is now a very incumbent issue in the medium term on debt. 30-year paper auction tonight. Let's see whether they chew on the words of Yellen. Let's return to some of the good news that we've had in the past 24 hours. We've got new all-time highs posted in the NASDAQ and the S&P 500. Now, while psychologically important, 5,000, that level, it may prove, well, how much of a hurdle will that prove? Markets have so far shrugged off the fears around commercial real estate to power ahead. We did some analysis at Bloomberg on the earnings calls, and they signal warnings on weak demand and a continuation of the AI frenzy. So the warnings of weak demand are dissipating. Let's see just how bullish he is. It is Oppenheimer's John Stoltzfus. He joins me now. So John, those warnings of, ahead, they're dropping off. The AI word search is ramping higher. Big shout out and thanks to Danny Berger for flagging that to me. How robust is this earnings season in your mind? John, good morning.
Well, good morning, Manus, and thanks for having me on the show. I must say, it's rather than robust, I think it's the picture of overall resilient. 11 hikes into this Fed funds hike cycle with 5 pauses, and with the Fed showing remarkable success thus far without pushing the economy into a recession. Developments in technology are certainly helping, but if we look at the earnings on the EA page of the Bloomberg terminal, while you do have double-digit negative earnings in energy, materials, and healthcare, you have double-digit earnings growth and substantial in communications services, consumer discretionary, and information technology, and in utilities. How's that? So overall, I think companies are showing greater resilience, and I think that's showing up. I also believe we're seeing greater capitulation, broader capitulation within the bear community, although we always are aware that the bears will find any interest, any catalyst possible to sell and take profits without FOMO after the kind of lift we've seen in stocks.
What are the signs of capitulation that you're seeing? Just expand on that for me, John.
Yeah, well, the signs are 2 very prominent short sellers. I think within the last 3 or 4 months on Bloomberg News, it was reported that they had ceased operations because it was just too difficult, and likely the cost to carry margin is much more expensive now than it was during the free money period. So if you get it wrong, it hurts a lot more, and if you get it right, if you're a short seller, you don't make as much as you got to pay the vig, so to speak. So when we look at it, it's the capitulation is also, we can't help but think, among some private investors who were just very nervous and were concerned. And then when they consider, particularly whether it is those preparing for retirement or in retirement, boomers who will likely live much longer than they ever expected, if you consider the difference between a 10-year at 4.5% yield versus stocks that are when they are fundamentally sound, okay, the good ones, likely to deliver better returns over the course of a few years, people are broadening their diversification back into equities. And I think that's what you have going on here.
Yeah, it's a question of whether you deploy all in. Now, in 1986, I was studying economics. I didn't know much about the rate differentials then, but I listened to Barkin this morning from the Richmond Fed, and he's talking about 1986, and they don't want a rerun of that, John, which is where inflation was tamed, and the following year it was certainly not vanquished, and they had to ramp rates again. When you listen to this cacophony of restraint from the Fed about cutting rates, what does that say to you about risk? Because risk is powering ahead without the Fed accepting that it's going to begin its rate cutting strategy anytime soon.
Well, I'd say, Manus, I started in this business in 1983, so I came in as Volcker was early in his second term as Fed chair. So, you know, I'm a student of the Fed action and the personalities that run it and the regimes that are created. And the Ben Bernanke legacy is the best that we've ever seen. And I think what's going on is I think within the market, we saw towards the end of last year at the beginning, the market was looking for, 5 to 6 cuts. To us, it looked like likely 2 cuts. We thought later rather than sooner. And it turns out it does appear that it's going to unfold that way. I think Jerome Powell wants to avoid in any way being Arthur Burns, and he doesn't want to have to take draconian action that Volcker had to take. And so likely they're going to be very careful before, and they're very clear, whether the market believes it or not, the Fed is being very clear in its communications that it does not want to cut rates and then have to go back and raise them. Our viewpoint now is the Fed will probably retain the pause long enough so when it cuts, it won't be cutting because we're in recession or about to go into recession, but instead they'll be saying enough is enough, based on where the levels of inflation will be when they begin to cut. It'll just be the right time to do it. And this is an extraordinary thing, but we did see, at least on parallel in 1994, going into 95, some similar kind of stuff.
Tell me this, we have David Einhorn at Greenlight Capital. Just a quick response on this. He said passive investors have no opinion about value. They're going to assume everybody else has done the work for them. I mean, he says markets are fundamentally broken because of passive investors. When it comes to breadth, do you think breadth is a laggard just because of the headlines that growth has sucked out of the air?
Well, I think perhaps it has. I would say this. I think the passive investing that is brought about by the ETF crowd, which I think Einhorn was addressing, it depends when you look at it. A lot of ETF investing is strategic allocation, but is tactically weighted in portfolios, so moves around, and actually is a play on equities for investors who are either looking for a place marker while they select individual stocks, in the case of small, mid-sized institutions, even large institutions, and on the other hand, for individuals, if they don't have exactly enough money to diversify broadly with individual stocks, the ETFs give them that opportunity. So we don't agree with Einhorn here, though we certainly respect him as a well-known component within the market.
Okay, John, thank you very much. John Stoltzfus with his views on the market, and indeed a student of the Fed from the Volcker tonight, coming up on the show. A strong profit outlook. Disney prepares for a big step in the world of streaming.
The focus when you do a three-way JV is on how do we make sure that we get the operating principles right so that the parties are aligned up front and they're aligned ongoing in delivering a great product to consumers. And that's the real focus here is how do we make it easier and reduce friction for the sports fans?
A conversation coming up next on Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
The focus when you do a three-way JV is on how do we make sure that we get the operating principles right so that the parties are aligned up front and they're aligned ongoing in delivering a great product to consumers. And that's the real focus here is how do we make it easier and reduce friction for the sports fans? We're really getting good traction and good momentum on managing our costs more tightly while reinvesting back in the business to drive the top line as well.
Disney delivering better than expected results, cost cutting, delivering the benefits, strong performance in the international theme parks. The company also delivering an upbeat outlook for the year, ahead of expecting to turn a profit in the streaming business by the fall. Geetha Raghunathan joins me now, Bloomberg Intelligence. Geetha, we caught up a little bit earlier this morning. You've got to say, this is precision engineering in turnaround story by Iger.
Oh, absolutely, Manus. I mean, the magic is back, and it is back big time. So we had a whole host of positives that Iger delivered. Of course, you had all the financial metrics that came in well above estimates. They have that guidance there, 20% EPS growth in fiscal 2024. That's 9% above consensus. And just kind of looking at all of the drivers that they put in place, right? All of these cost-cutting initiatives. You have a share buyback program. You have the streaming business kind of hitting profitability. And then you have the new initiatives, right, with the ESPN, the two bundles. One is the ESPN standalone. The other one, of course, is the combined product. I mean, they're really setting themselves up for strong EPS growth for many more years. So this is turning now into a profitability story and a capital return story.
It is, and if you look, of course, he's joining in on this new evolution, this new iteration on streaming. It's pretty powerful trifecta. But you also make the point about ESPN having its own evolution apart from the new sports streaming service.
Yeah, so the ESPN standalone is going to be, I think, a little bit different from that sports super app, which is going to come a little bit later this year. The ESPN standalone service, which will come out in August of 2025, basically is going to integrate sports betting. It's going to have, personalization, maybe some fantasy leagues, e-commerce, so all kinds of different features. But ultimately, Disney's play is really about the bundle. I mean, they have the best streaming bundle, Manus, out there on the market. They know that about 40 to 50% of their subs are actually taking the bundle. So this really resonates with customers. And you're absolutely right. I mean, this reduces friction, right? Customers at the end of the day want something that is simple, right? It's really simple to use. And the bundle does that for them. And taking ESPN over the top allows them to sell this comprehensive bundle. And they think it's going to work because it has so far.
I mean, I switch on my own TV. I've got Amazon, I've got Apple TV, I've got Netflix, and you're flicking around on a constant basis. I wouldn't mind a one-stop shop on that. Geetha, thank you very much, Geetha, on the very latest with Disney. Well, for some more price action this morning, let's get back to Katie Greifeld in terms of the movers. Katie, what have we got?
Well, you take a look at what the sectors are doing right now. The S&P 500, it's below that 5,000 level, but the sectors, it's pretty much an even split. It's changing a little bit. You have 7 sectors in the green right now. We're led by energy. It feels like we haven't seen that in a while, up about 0.6%. Consumer discretionary and consumer staples also managing to stay in the green here. Then you take a look at what's not working. You do have 4 sectors underwater right now. That is materials, it's healthcare, it's utilities, and it's financials. Of course, a lot of focus on the financials, particularly those regional lenders, but you add it all together, though, and the sector as a whole is under pressure. We'll see how that story plays out, Manus.
Okay, Katie, thank you very much. Katie Greifeld there on the sectors. Coming up on the show, market moving events. Can we stay above the 5,000 level? Will we continue with the dizzying records that we are making in the United States of America? Oh, it's below 5,000. Let's see how the rest of the day goes.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
Told you there were psychological barriers in this market. We're failing at the 5,000 level. NASDAQ continues higher again, record after record high. Robustness in the Russell 2000. Disney's on the pump, ARM's on the pump, higher as well. 30-year government bond yields are going to be at the bottom of your screen. We're waiting for that auction to hit the tape to this afternoon. 436 is where we trade. This is what you got to keep an eye on. More Fed speak if you haven't had enough. We've got the Fed President Tom Barkin, the Richmond Fed. That is at noon Eastern. He's just been on Bloomberg. The 25 bucks of 30-year paper, 1 p.m. Eastern time. What is the tail? Will they turn up like they did for the 10s? PepsiCo earnings before the bell on Friday. And more Fed speak. Dallas Fed, Laurie Logan.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Your fixed income fix. Watch Bloomberg Real Yield at its new time Friday at 12 p.m. Eastern right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in on Disney. Had a pretty good quarter for them, and they're actually launching some new sports streaming stuff, so I think I'm going to have to pay more to get sports. I don't know how that's going to work, but that's usually how things play. Dan Griffith, Senior Vice President and Director of Wealth Strategy at Huntington Private Bank. He's going to join us. Alex, I see a headline here. Devon Energy in talks to buy another energy. I mean, it's just another M&A trade in the energy space. There's going to be nothing left.
Yep, it's according to reports from Reuters that Devon Energy is in talks to acquire Enerplus. This is just deal after deal after deal. But I look at Conoco because Conoco's always been ahead of all of these trends. They've been the trendsetter, and they're not buying anything now. So that tells me something. They already bought.
Okay.
So that tells me that maybe are we going to get into the peak M&A cycle here for the show,
very
guys.
good. All right, we'll see if we can get some more reporting on that. We got a lot coming up here as well. But right now, let's kick it all off with Mr. John Tucker in a Bloomberg Business Flash.
All right, and we're brought to you by Interactive Brokers. IBKR's redesigned Fundamentals Explorer provides comprehensive worldwide fundamentals data to clients at no cost. Take your research to the next level. Visit ibkr.com. Well, let's start with the energy, because right now that is the best performing industry group in the S&P 500 right now. You have, let's see, 6 or 7 of the 11 industry groups. They are higher right now, being led, as I said, by energy. The S&P 500, we're on 5,000 watch again today. Right now it's dead flat. We're about 5 or 6 points away, 4994.5. Again, the initial jobless claims falling for the first time in 3 weeks. That was the data, the economic data we got this morning. So that suggests employers still largely holding on to their workers. And then you have Federal Reserve Bank of Richmond President Tom Barkin reiterating that policymakers have time to be patient about the timing of cuts. Meantime, Ben Laidler at eToro is seeing stocks pushing higher and even broadening out.
Right now, we're talking about rate cuts. We're talking about earnings acceleration. Later in the year, I think we're actually going to be seeing them. That is, I think, the trigger for the rotation from, these crowded and justifiably very expensive and well-performing big tech names, frankly, into everything else.
And after yesterday's successful 10-year auction, 10-year yields today, 4 basis points higher. That's at 414 for the benchmark. The 2-year is up 1 basis point right now, and that is at 444. S&P 500, again, unchanged, 49.95. The Dow Jones Industrial Average, 17 points higher. And the NASDAQ 100 right now, 17 points higher. That is up less than 0.1%, 38,787. I suppose when we hit 5,000, if we do, we'll have confetti raining down from the ceiling.
Yeah,
a little champagne, maybe.
Yeah, round numbers.
Do you remember? Well, you were like 5 when the Dow hit 10,000.
Of course.
But at the time, my boss said, don't make a big deal of it. It's just another number. And I'm like,
sure.
What?
But also for this one, there are options that are trading around that, and then you get options expiring tomorrow. So there's going to be action around 5.
There'll be some action on that.
So that's why we have Alex here.
That's why we have Alex.
So much smarter.
Bring a little bit of intelligence here. All right, very good. John Tucker, thanks so much. We appreciate it. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. So I'm looking at this Devon deal, but I guess Interphase is about a $3 billion market cap company. Stock's up 7% on this news that Devon is in talks potentially with them. That's according to Reuters. Devon Energy, that's a big company. It's looking at a $27 billion market cap company. And the looking that Enerplus is the company based out of Calgary, Canada. So another potential deal in the energy space. Keep on top of that. Seems like there's a lot going on there. Right now, let's see what's happening with these equity markets. Let's check in with Nora Melinda. She covers equity markets for Bloomberg News. Nora, what do you have for us?
Let's take a look at PayPal. We've got investors spooked this morning by its disappointing fourth quarter outlook. The firm said it expects earnings to be flat this year, and it blames that plateau on cost cuts and operational streamlining. Just last month, as you remember, the firm said that it would cut 9% of its workforce to boost profits. And just back in November, it blamed slow progress on its cost base and complex structure. The CFO said that it plans to buy back at least $5 billion of its stock this year, and it will now provide a revenue forecast each quarter rather than on an annual basis. She said, quote, "We are just doing too many things. We have to make decisions to stop doing things and just focus."
Wow, that doesn't instill a lot of confidence.
So I tell my daughter, stop doing things and just focus on brushing your teeth.
Exactly.
I'm glad that PayPal is also doing something similar.
Hopefully it works. I mean, the stock's down 9% today, down 28% in the trailing 12 months. I followed this company for such a long time when it was part of Amazon, and they just never, I don't know why they haven't benefited from this fintech revolution. You would have thought that they would be the poster child.
You would think.
Yeah, but I don't know. It's just, they just,
didn't
I guess,
in the
too much
way.
stuff going on, I guess.
Too much going on. Got to look at one thing, focus.
And then you're looking at Paul's love here of the day, Disney.
Yes, how can we not?
Yes, sure. I mean, fair enough.
Disney shares are soaring up 10% for the biggest one-day gain since 2020. Earnings rose to $1.22. This is beating the 99-cent average prediction from Wall Street. Not only that, but it issued an upbeat profit outlook for the year. This is all thanks to cost cutting. The firm said that profit this year will rise at least 20% to about $4.60 per share. Analysts were expecting $4.27. Of course, we did see some subscribers falling off as it relates to Disney Plus streaming, and as we think about sports and whether or not they're actually going to be doing some streaming in that space. But overall, when we're looking at the numbers, it's a pretty solid beat. People are excited about this EPS beat and the rosy outlook.
And we'll be talking to Geetha Ranganathan from Bloomberg Intelligence in just a moment to get the breakdown. But yeah, it's nice to see the stock move. They're doing, talk about having a lot of balls in the air. I mean, they've got, what assets do I want to own? What do I want to sell? What do I want to merge? What do I want to stream? Oh yeah, I own the parks business, which is now the biggest profit driver for us. There is a lot going on there.
Where do they go to the parks? Is it in this country or abroad?
Everywhere. They doubled their capital spending for the theme park business over the next 10 years because it's a great business. And so they've got obviously Disney World, Disneyland here in the States, but they've also got, that joint, they get that ownership in Paris. The big thing is
I just never thought
Hong
they
Kong,
would
Tokyo,
translate
and Shanghai.
Disney World in France.
Well, actually, what they learned in France is, what they learned in France is it doesn't. And that was a mistake they made in France. That they didn't even take into account that, like what they say now is authentically Disney, but where it's tailored to your local market. So they learned from what not to do in Paris. And so now when they went to Shanghai, for example.
So Mickey's like rude?
Exactly.
Mickey smokes and drinks coffee in a cafe.
Exactly.
But that's where I would take my daughter. I would go to Disney in Paris. Less lines, less drama. I'm just saying. I have to say, I was breaking earnings yesterday on television when Disney came out. But one company that kind of stole the spotlight a little bit was ARM.
ARM?
Yes.
Those shares are flying this morning, up as much as 44%. That's the biggest one-day gain and highest price on record. As we know, this company IPO'd just back in September. Its push beyond smartphones is really helping to facilitate growth. It said that revenue in the 3 months ending in March will be between $850 to $900 million. Analysts were looking for $778 million. And just a bit of a rosy outlook. It says that earnings will be roughly 30 cents versus analyst expectations of 21 cents. And as we think about this company, its customer base has a lot of these big names. If you think about Apple, Amazon, Qualcomm, they're all looking to ARM for designs in some sort of capacity. And its CEO did say that it's really looking, this reflects the expansion into new markets. He said that we are involved in just about every single end market, and just about every single market is putting more compute into their devices.
All right, and at 11:03 a.m. Wall Street time, ARM CEO Renee Haas will speak with Bloomberg Technology hosts Ed Ludlow and Caroline Hyde, so stay tuned for that. We'll get the latest. The stock's at 57% today. Are you kidding me? I mean, this isn't a penny stock. This is a $120 billion market cap.
It's basically royalty company.
Yeah, there's not a lot of, what I understand is, I have to go back and do the work, but I understand there's not a lot of float out there, so it can kind of be volatile, but still 50% for a $120 billion market cap company. You don't see that every day. Norma, Linda, thanks so much for joining us. Really appreciate getting the breakdown on these markets. Let's go back to Disney, another stock that's having a good day, up about 9% here in early trading on the back of a quarter that for some people was, kind of like, boy, I think they've got their handle on this thing now. And Laura Martin at Needham, she upgraded the stock to a buy today, so that's helping the stock up 9.9% here today. Let's check in with Geetha Ranganathan. She covers all the media stocks in the industry for Bloomberg Intelligence. She's been all over this name here. Hey, Geetha, the stock's up about 10% here. What do you think the market's reacting to here today?
Yeah, I mean, Disney is definitely back, Paul, back with a bang. Market is reacting to all of the profitability that they're seeing with this company. I mean, one of the big pain points with Disney has really been the lack of streaming profitability, but now there seems to be a clear path to the streaming business kind of getting to that profitability metric. So we saw the losses come in way below expectations. It was 65% below what people were projecting. They're still kind of guiding to, hitting profitability by the September quarter, but most people, I think, on the street expect it to happen much, much sooner. And then Hugh Johnston, who's the new CFO, and this was his first call with Disney, basically said that look to or expect double-digit operating margins in the streaming business. And I think that was something that was really, really powerful because we know that, the number that we're all chasing is that 20% operating margin where, Netflix has been with their streaming business.
So Geetha, based on what we got, what is your question today versus your question yesterday?
I mean, I think the one area that we kind of still need clarity is how all of the streaming bundles are going to work. So it's really good to see them kind of be proactive and go out with their own solution. So they have that sports super app that's coming out a little bit later this year in conjunction with Fox and Warner Brothers. They have their own ESPN Plus standalone app. Again, a little bit of, we're not really sure whether those are necessarily going to cannibalize each other. I don't think so. I think really Disney, what they're trying to do here is kind of create this super bundle because they know that, content bundling works and everybody's kind of looking, aggregation is the holy grail. And I think Disney wants to be at the forefront of it. But definitely we need a little bit more kind of clarity, at least around like what the financial value creation is going to be.
How about the theme park business? That seems to continue to be a really solid business for them. And I know they announced several months ago that they're really stepping up their investment in their theme parks and their cruises and all that kind of stuff. How did that business do?
Very, very well. So again, operating income was for the quarter was well above $3 billion. That was again above what the street was expecting. And really what we're seeing is a lot of momentum at the international parks. So they opened, they've opened so many new attractions in their overseas properties. You have a new Frozen Land in Hong Kong. You have the new Zootopia attraction in Shanghai. And both of those are doing really, really well for the company. And that has really enabled them to implement all of these price increases. So international parks really kind of doing extremely well. Domestically, there's a little bit of pressure from wage inflation. There's a little bit of pressure from, tough comps from like the Walt Disney World 50th anniversary celebration. But again, just transient. Parks are really set up very, very well. And you mentioned the $60 billion investment. Now, 70% of that CapEx is going to be towards new attractions. So this is really going to be a major, major profit driver for them going forward.
Geetha, there was a journal article that I just felt like helped someone like me who's not seeped in Disney like you guys understand how they're just seeping in to all the Americana that's out there. They said Taylor Swift, football, and Fortnite. That like anywhere that you will want to be or listen to or watch, Disney will be there. What did you make of the Fortnite investment?
Super smart move by them, right? It's so strategic, it's so smart, and it's still a kind of not a huge investment. 1.5 billion gives them some stake, gives them some skin in the game, and there's a lot of upside, not too much downside. So I think a really good way for them. And remember, Alex, they've had this kind of really checkered past when it comes to video games. It's not that they haven't been there. They were in the publishing business, didn't really work out for them. They exited that business in 2016, started licensing out a lot of their content. But licensing, you're still kind of this passive participant. They really need to be there. They need to be an active participant in the video gaming industry. There's so much overlap between all of the audiences that go to the, the Disney parks and the people who are gaming, right? It's all these youngsters, and they really want to be there. And this is a great way for them to do it.
Well, a listener just writes in here and says, Taylor Swift also announced her concert movie would be exclusively on Disney Plus starting next month.
With
Samantha,
5 new
thank
songs.
you for that. What's
With 5 new songs.
Really?
Yeah, so if you already saw it, you're going to want to see it again because there's 5 new performances on
John
it.
Tucker's all fired up for that. All right, so...
I'm going to have to sit through it. The two of you are going to have to sit through
exactly. Geetha, talk to us about the movie business, the film and entertainment business. That was, at one point, for a long time, just a source of tremendous value. It was just smash hit after smash hit. Billion-dollar box office became the norm. What are they saying about their theatrical business?
Yeah, and they were asked about this last night, Paul. And the content, the studio has not really been the blockbuster that that it was. We've had a whole string of misfires over the past few months. But I think what Bob Iger was saying is they are in the process of rebuilding. Their whole content pipeline is refilling. They're having this really smart move here with this new Taylor Swift movie coming out on March 15th. And then they spoke about, having this new Moana movie. This was originally going to be a series on Disney Plus. It's now going to be a full-blown theatrical release. And again, we're prepping for 2026, really, which is going to be the biggest year for the box office ever since the pandemic. And a lot of that will be Disney kind of driving the slate, right? You have the whole Star Wars coming back with Mandalorian and Grogu. You have a whole set of Marvel releases. So it's going to be really interesting as we kind of build to that. So again, nothing really major in 2024, maybe other than, kind of the Deadpool movie. But we're kind of building towards a much stronger slate
I'm sorry.
in 25, 26.
Nothing big coming except for the Deadpool. Excuse me. I've been waiting for this movie for years. Deadpool 3?
You're a big fan of the franchise.
Definitely not my audience that I'm talking to right now. Okay, but that's the main
I
event.
thought you said Deadpool. I thought it was like a financial movie.
Have you never
I
seen
would have gone
Deadpool?
see that.
Have you not
Reynolds.
seen Deadpool?
It's very Ryan Reynolds.
It is
very
brilliant.
Funny.
I don't go out much.
This is the third one. You're having Wolverine make a little cameo, whatever. Anyway, it's going to be awesome. Paul, what do you make of how fast Disney was able to move?
Well, a lot of people tell you they didn't move fast enough, but I think
Bob Iger came in. I mean,
yeah, and but the stock's been kind of dead money for a while, and Geetha well knows here. It's just a question of when can we get a sense of when those streaming losses are going to be in the rearview mirror. And Geetha, Bob Iger surprised us, I guess a year or so ago when he said some of these assets might be for sale, like the ABC network, some of the cable networks. Any update on that?
No, so, yes, he did. We did have him kind of say everything's up for sale. And then he kind of walked back all of that. And now it's kind of starting to make sense because they're obviously taking all that content, they're putting it now on the super app. So it makes sense for them to still kind of hold on to their linear TV assets because they still do have very valuable sports rights on there. So I think they're kind of aiming for this bigger, kind of grander strategy. I don't necessarily think that they're looking to sell any of their linear TV networks right now.
Oh, interesting. Okay, very good. Geetha, great update. Thanks for taking the time. Geetha Ranganathan, she is the media analyst for Bloomberg Intelligence, joining us via Zoom from the HQ down in Princeton, New Jersey. So Disney stocks up about 10% here. Good day for the mouse.
I'm also excited for Moana too, just so we know.
Okay.
That's huge for my daughter.
Yeah.
Get a princess is not a princess. Golden. We love
Exactly.
this.
Boy, it's interesting because, I mean, they just had blockbuster after blockbuster for a good 10 years, but now they've had some tough times, so see if they can, I guess, get that magic back a little bit. We're going to have more coming up. This is Bloomberg.
headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News. With this Bloomberg Business Flash, not a lot of movement in the S&P 500. In fact, it's dead flat as we are on 5,000 watch, just 5 points away. 49.95 on the index. Look under the hood of the broader index. you'll find that we have 6 of the 11 major industry groups higher right now, being led higher by energy. And the biggest drag, that is coming from financials. In terms of the index points right now, the biggest drag that's coming from PayPal Holdings after their earnings report. Those shares, they are down just about 10%. And as the earnings season rolls in, Walt Disney, ARM Holdings, they are jumping based on their upbeat outlooks. Bitcoin, that is hovering right around 45,000. And Treasury yields, they're creeping higher. Those on the 30-year bonds reaching the highest levels in more than a week. So this comes ahead of the auction on the long bond today. The 10-year auction yesterday, that was successful. That pushed stocks and Treasuries higher. 30-year yield right now 4 basis points higher. That's at 437. The 10 up 5 at 415. As for the other major indexes, the stock indexes, NASDAQ 100, 18 points higher. That's up 0.1%. Dow Jones Industrial Average down just 16 points. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex.
Yes.
With her light on.
I have my light on. Paul does not. Just some headlines here coming from U.S. Treasury Secretary Janet Yellen testifying at the Senate Banking Committee hearing. So she's saying that non-bank concerns are relevant, that there is concern in market stress and could see a non-bank failure. Non-banks don't have access to backstop funding. So sort of, which I find, obviously, that's what we're kind of all waiting for and hoping to see that that doesn't actually happen. But she's obviously warning of that market stress and the non-bank failure. Okay, we got that. Yeah, all right. All right, in the meantime, we're like almost close to 5,000 on the S&P. So I realize it's a round number, but we still care. Let's see if Dan Griffith cares. He is a Huntington Private Bank. He's a vice president, senior vice president there and director of wealth strategy. Dan, I appreciate that you're longer term and like 5,000 won't mean a lot. However, what I keep being struck by is that we are continually oversold, way above our skis, but no one wants to sell right now as we near 5,000.
No, I think that's right. I think what's interesting is, and maybe this is for retail customers too, the 5,000 number does make a difference because broadly it gets people to say, oh, maybe there is some confidence in the market. And I think there are a lot of underlying factors that support that. But I think round numbers sometimes do kind of wake people up and get them to say, maybe this is something I should pay a little more attention to.
So what are you paying attention to these days, Dan? We had a great finish to 2023. Probably took a lot of investors, by surprise here. What are we doing here in February?
I think we're looking at a lot of core numbers, and right now a lot of them look very positive. Obviously we're looking for earnings growth next year, this year, maybe 10% or more. We're looking at jobless numbers. Again, we got a good number this morning, which I thought was really positive on the heels of, some great numbers earlier this month.